Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's dive right in. Today, we're talking about a plan for building wealth in the stock market. Now, this isn't some fly-by-night theory. It's a strategy built on 40 years of real-world experience navigating the markets, both the good and the bad. It's from the work of Colin Nicholson, and it's all designed to do one simple thing: give you, the private investor, the tools you need to succeed by completely changing the way you think about the game. So let me ask you something, and be honest with yourself here. Have you ever been in this exact spot, just staring at a stock that's deep in the red, and you're not selling, you're just holding on, hoping, maybe even praying that it'll somehow claw its way back to the price you paid for it? We've all been there. It's a tough and, frankly, a very common place to be. Okay, now take a look at this. We've got two investors here. Investor A looks perfect, right? All wins, not a single loss. A clean sheet. Then you've got Investor B, whose record is, well, it's messy. A mix of some nice wins and some definite losses. But here's the kicker. At the end of the day, they both walk away with the exact same profit. Now, who would you rather be? Come on, we all know the answer we want to give is Investor A. But the secret to long-term success, it actually looks a lot more like Investor B. And that's exactly what we're going to unpack. See, winning at this isn't about having a perfect, flawless record. That's a complete fantasy. It's about having a system, a real plan that can take the hits, manage the losses, and still come out profitable in the end. This is the plan that truly separates the winners from everyone else. And that brings us to the first big idea. Winners just think differently. And I don't mean that as some motivational poster slogan. It's a deep, fundamental shift in how you see the market. The goal isn't to be right all the time. The goal is simply to be profitable over time. It's a huge difference. And you can see that mental shift right here. The beginner is completely anchored, almost chained, to the price they paid for a stock. That one number from the past dictates everything. They're stuck looking in the rearview mirror. But the winner? They're looking out the windshield. They're asking, what's this thing worth today, and where is it likely to go from here? The past is irrelevant. And this quote just nails it. Let this one sink in for a second. No matter how much the stock cost us to buy, it is irrelevant to what we do now. That money is gone. You can't change what you paid. The only decision that matters, the only thing you have any control over, is what you do now with the capital you have left. And this is exactly why that mindset is so critical. Just look at the brutal, cold math of losing money. A small 10% loss isn't so bad. You need an 11% gain to get back to even. A 20% loss needs a 25% gain. But watch how the math starts working against you. A 40% loss needs a whopping 67% gain, but it gets so much worse. If your stock gets cut in half, a 50% loss, you need a 100% gain just to get back to where you started. You have to literally double your remaining money just to break even. The deeper the hole you dig, the harder it is to climb out. This is why preserving your capital is the absolute #1 rule of the game. Okay, so how do we actually do this? How do we avoid those big emotional mistakes? Well, this is where we shift from thinking to doing. You need an investment plan. You have to start treating this whole thing like a serious business, not a casual hobby or a weekend trip to Vegas. You know, most new investors fail for the same few reasons. They're the usual suspects. They start with too little money, they don't really know what they're doing, and most importantly, they have no plan whatsoever. And because there's no plan, their decisions are terrible, and they never learn from their mistakes. A solid plan? Well, that's the antidote to almost all of these. And here's where your plan really proves its worth. It's easy to be a genius when the market's just going up. But what about when things get choppy? When the news is bad and fear is everywhere? That's when amateurs panic and get wiped out. Your plan is your North Star. It's the reference point that keeps you grounded and stops you from making stupid, emotional decisions when the pressure is on. Now, a huge part of any good plan is understanding market risk. And risk isn't just a number, it's about emotion. Markets move in cycles, and those cycles have been driven by the same two emotions for hundreds of years: fear and greed. Knowing which one is in charge is one of the most powerful skills you can possibly develop. At the very highest level, it's pretty simple. You've got bull markets where everything's generally heading up, and you've got bear markets where everything's generally heading down. The most important thing to remember is that one always follows the other. They come in phases. So, a new bull market doesn't start with a big party. It starts in stealth. It's born from the ashes of the last bear market, when everyone is pessimistic and nobody believes the good times are back. But as prices start to creep up, the pros start to feel that fear of missing out. This is when stocks are cheap, and the really smart money is quietly buying. Then we move into the awareness phase. This is the sweet spot. The trend is obvious now, company profits are up, the economy looks good, and prices are rising in a nice, orderly way. This is the longest, safest, and easiest part of the bull market to make money in. The trend is your friend. And finally, you get the most dangerous phase, rampant speculation. This is when your neighbor is giving you stock tips, everybody's piling in, prices go parabolic, and volatility goes through the roof. And you'll hear that famous phrase over and over, "This time it's different." That is a massive, flashing red light telling you the end is near. And what happens after the party? The hangover. A bear market always follows a bull market. And it has its own ugly phases too, from the smart money selling to the clueless public, to earnings falling off a cliff, and finally to pure panic in the streets. Knowing when to get off the dance floor is just as important as knowing when to join in. Okay, so after all that, the mindsets, the plans, the market cycles, what's the one thing you can actually do? Well, it boils down to what Nicholson calls the simple big idea. It's a straightforward two-part rule that is designed to put the odds in your favor. The whole idea is based on the Pareto principle. You've probably heard of it as the 80-20 rule, right? Well, in investing, it means that a huge chunk of your profits, like 80%, will probably come from a very small number of your trades. So the whole game is about finding those few big winners and managing the rest. And here it is. It's this simple. Part 1, you only buy stocks that are already going up. Stocks that are in a strong, confirmed uptrend. No bottom fishing, no trying to catch falling knives. You follow strength. Part 2, you cut your losses. Immediately, without question. The second the trend breaks or your reason for buying is gone, you get out. That's it. Let your winners run and kill your losers fast. Now look, let's be really clear about something. This is not a crystal ball. It's not about predicting what's going to happen tomorrow. Nobody can do that. This is a system for reacting to what's happening right now. It's a disciplined approach that takes your ego, your hopes, and your fears out of the equation. So what's the bottom line here? It's all about making that journey. The journey from being an amateur who reacts to news and hot tips to becoming a disciplined investor who just follows a plan day in and day out. It's a process. And yeah, it takes some work. So let's just quickly run through the key takeaways. First, treat this like a business. Have a written plan. Second, understand that losses are just a cost of doing business. The secret is to keep them small. Third, respect the big market cycles. Don't try to swim against a tidal wave. Fourth, apply that simple big idea with ruthless consistency. Ride your winners and cut your losers. And finally, remember that a good process will always beat predictions in the long run. Look, this isn't a get-rich-quick scheme. It is a blueprint for building real wealth, methodically, over time. So after everything we've talked about, the only question left is the one right here. The market is a long race. Are you prepared to stop gambling and start running it like the business it truly is? Thanks for your time today. Have you ever felt like the stock market is this huge, complicated game, and maybe everyone else got the rule book but you? It's a really common feeling, believe me. But it doesn't have to be that way. Today, we're going to give you the playbook, a simple but really powerful framework that's going to help you build wealth with confidence. We'll start with the most fundamental questions you have to answer before you even think about investing a single dollar. So let's just get right to the heart of it. When you click that buy button on a stock, what game are you really playing? Seriously, think about it. I've seen so many people just jump into the market without a clear answer to this. It's kind of like sitting down to a game of chess, but you have no idea how the pieces move. Sure, you might get lucky once or twice, but you're never going to win consistently. The answer to this question, well, it's the foundation for your entire strategy. Okay, let's dive into this first big decision. This is the bedrock of your whole approach. You have to choose your identity. Are you going to be a speculator? Or are you going to be an investor? And these aren't just fancy words. They represent two completely, and I mean completely different philosophies about how to make money. And this slide really nails the difference, doesn't it? The speculator, they're basically a gambler. They're at the casino, rolling the dice on a stock price, just hoping for a quick win. They're all about those short-term price swings, and honestly, dividends are just a happy accident if they happen at all. The investor, though, is totally different. They're like a partner in a business. They are in it for the long haul because they're focused on the company's real underlying value and its ability to generate consistent returns year after year. This quote just perfectly sums up that investor mindset. It's a simple three-part approach. Number 1, protect your principal. Don't lose your money. Number 2, collect your income stream from things like dividends. And number 3, let your capital grow over time. It is the fundamental difference between being a business owner and just being a lottery ticket holder. All right, so you've decided to play the long game. What's the prize? If you're a patient, disciplined investor, what does history tell us about the potential rewards? Well, the answer might actually surprise you. And there it is, 9.6%. That's the average annual return of the U.S. stock market for the last 100 years. Now, to put that into perspective for you, at that rate, you double your money roughly every 7.5 years. That is the incredible, almost magical power of compounding, and it is the engine that drives true long-term wealth creation. But where does that return actually come from? Now, here is a key insight that most people completely miss. Look at that chart. Nearly half of that 9.6% return comes from dividends. That's right, the actual cash that companies pay out to their shareholders. That accounts for a huge chunk of long-term gains. It's just a powerful reminder that investing is about owning a piece of a real business, not just watching a ticker symbol flash on a screen. So, you've embraced the investor mindset. Fantastic. The next question is, what kind of investor are you going to be? Are you going to be hands-on, an active participant who's always making moves? Or are you going to take a more passive, set it and forget it kind of approach? This is the next crucial decision you have to make. The pros have a couple of fancy terms for this. Market timing versus time in the market. The active investor is kind of like a surfer, right? They're trying to catch that perfect wave, ride it up, and get out just before it crashes. The passive investor, they're more like a farmer. They're planting seeds, patiently waiting for the harvest, knowing that some seasons are going to be better than others, but trusting in the long-term growth. Now, the passive investing camp, they have a really powerful argument against trying to time the market, and it's this. If you miss out on just the 10 top best days in the market, your returns will be absolutely decimated. It's a super compelling point, and you know what? The data absolutely backs it up. But here's the other side of that coin. What if, instead, you could avoid the 10 times worst days? What if you were safely on the sidelines in cash while everyone else was getting crushed? Well, your returns would be astronomical. And that right there in a nutshell is the incredible allure of taking an active approach. Now, here's something important. Regardless of whether you choose an active or a passive strategy, as a private investor, you have to perform two totally distinct functions. You have to learn to wear two different hats, the hat of the analyst and the hat of the investor. And these two roles, they're often at odds with each other. Your inner analyst is absolutely obsessed with being right. They'll spend countless hours researching a stock, and if it doesn't perform exactly as expected, they take it personally. Your inner investor, on the other hand, is all about the bottom line. They know they're not going to win every single time, and they're perfectly happy to cut their losses on a bad idea and move on to the next opportunity. We all know this analyst type, right? They're the ones who read the instruction manual for a new gadget from cover to cover. They love a good spreadsheet, and they will spend hours debating the tiny details of some valuation metric. They're brilliant, for sure, but that need to be right, it can also be their own worst enemy. The investor mindset is a total contrast. It is all about results, period. They're comfortable changing their opinion the moment the market proves them wrong. They tend to use simple but really robust models, and they fully accept that not every single decision is going to be a winner. Their focus is always on the net result at the end of the day. And here's the kicker. As an individual investor, you have to be both of these people. You have to be the brilliant, detail-oriented analyst and the pragmatic, results-driven investor, all wrapped up in one. It is a tough balancing act, no doubt, but it's absolutely essential if you want to succeed. So, when you're wearing your analyst hat, what tools do you actually use? Well, market analysis is generally divided into two broad schools of thought, two different toolkits for forming an opinion about a stock. You've got fundamental analysis and technical analysis. Okay, so fundamental analysis is like being a detective. You are trying to uncover the true intrinsic value of a company by digging into its financials, its management team, its position in the industry. You're looking at things like PE ratios, earnings growth, debt levels, all to figure out if a stock is a real bargain or maybe a total bust. Technical analysis, on the other hand, is more like being a psychologist. You're not really concerned with the company's balance sheet, you're focused on the behavior of the market itself. You're studying charts, looking for patterns, identifying price trends, support levels, resistance zones, really trying to understand the collective emotions of fear and greed that drive the market. Now, here's a little secret that a lot of the Wall Street gurus don't really want you to know. You don't have to pick a side here. You don't have to choose between fundamental and technical analysis. In fact, some of the most successful investors use both. They use fundamental analysis to find great companies, and then they use technical analysis to help time their entries and their exits. It really is the best of both worlds. Okay, let's bring all of this together now. We've just walked through all the essential building blocks of a really sound investment framework. So now it's time to think about how you can assemble these pieces into a strategy that actually works for you. This slide basically summarizes our whole journey today. You've got 4 key decisions to make to form your own personal approach. First, define your identity, speculator or investor. Second, choose your strategy, active or passive. Third, get a handle on your mindset. How are you going to manage those 2 hats of the analyst and the investor? And finally, number 4, select your tools. How are you going to blend fundamental and technical analysis together? Look, we've given you the map. We've shown you the compass. But now it's up to you to chart your own course. The path to building wealth on the stock market is not some one-size-fits-all solution. It's a personal journey of discovery and self-awareness. So I'll just leave you with this one question. What kind of investor will you choose to be? The answer? Well, it could change your life. All right, let's jump right in. We're going to dig into a really powerful idea today. When it comes to investing, what truly separates the winners from, well, everyone else? It's not some secret stock tip or how many hours they work. It's not even about how much they know. The real game-changing edge is all in how they think. So let's get into it. And yeah, this is really the heart of the matter. This single idea, if you let it sink in, it changes everything. It's not about searching for a magic bullet. It's about building a better way of making decisions, especially when things get uncertain and the pressure's on. That skill is what really makes the difference when the chips are down. So here's our game plan for today. First, we're going to nail down what that real winning edge actually is. Then, we'll dive into the psychological traps that almost every beginner falls into. After that, we'll look at the counterintuitive, almost backward-sounding rules that winners live by. We'll also talk about redefining what your goal should even be. And finally, we'll wrap up by looking at investing as a process, a long-term journey. Okay, Section 1, the real winning edge. And believe me, the subtitle here is key, because most people, especially when they're starting out, are looking in all the wrong places for what's going to give them an advantage. I mean, think about it. Knowledge is great, sure. Experience helps, no doubt. But if you can't translate that into high-quality, rational decisions, they're pretty much useless. The best of the best have sharpened this one skill above everything else. And the best part? It's a skill you can actually learn. Now, it's one thing to understand the edge, but we also have to understand what we're up against inside our own heads. And that brings us to the psychological traps that sabotage most people. These are the mental hurdles, those gut feelings, that are just flat out dangerous and costly when you're dealing with your money. Okay, I've got a question for you. I want you to really think about this. When you look at a stock you own, what's the very first, most important number that pops into your head? Your answer here? Well, it tells you a whole lot about your mindset. And here it is, the big difference. A beginner is completely chained to their purchase price. It's called anchoring. Every thought they have is stuck in the past. But a winner knows that what you paid for it is totally irrelevant. That number is history. The only question that matters is, based on its value right now, what's the smartest move going forward? It's a huge shift in thinking, and it's incredibly freeing. Oh, this is a classic one. Here's another dangerous trap. When an investment goes up, beginners start telling themselves this story that they're now playing with house money or the market's money. A winner, they know there's no such thing. A profit isn't real until you've cashed it out. Until then, it's all your money, every last cent, and you have to protect it just as fiercely as the money you started with. You know, this might be the biggest trap of all. Beginners don't just invest their money, they invest their ego. So a bad trade isn't just a loss, it's a personal attack. It means I'm an idiot. Their self-worth gets hammered. Winners, though, have learned to detach. For them, it's just business, a transaction. Some work out, some don't. It's never personal. That emotional distance is what lets them make clear, objective decisions when it matters most. All right, so we've seen the traps. Now, how do we avoid them? Let's talk about the winner's rulebook. And here's the catch. A lot of this stuff is going to feel completely backward. It goes against every natural human instinct we have. This is rule number 1, the bedrock, the prime directive, if you will, capital preservation. Before you even dream about making a profit, your first and most important job is to not lose the money you have. It's simple, really. You can't win the game if you're not at the table, and huge losses are what get you kicked out of the game for good. Now, if you're wondering why that rule is so important, just look at this table. The math here is just brutal. It doesn't lie. A 10% loss, okay, you need an 11% gain to get back to even. Not so bad. But look what happens. A 30% loss needs a 43% gain. A 50% loss, you need to double your money, 100% gain, just to get back to where you started. And a 90% loss, that's a 900% gain. It's practically impossible. The hole just gets too deep to climb out of. So how do you avoid that nightmare scenario? Well, it boils down to this incredibly simple 2-step rule. You absolutely have to cut your losses while they're still small and manageable. And, just as important, you have to let your winners run. Let the profits build. It's the complete opposite of human nature, right? Most people rush to take tiny profits and then hold on to their losers forever, just praying they'll come back. Winners do the exact opposite. And that leads us perfectly to this next big shift in perspective. What is the actual goal here? Because trying to be right on every single trade, this quest for perfection, that's a sucker's game. Winners are playing a totally different sport. All right, have a look at this. 2 investors. At the end of the day, they both end up with the exact same net profit. Now, be honest, which track record looks better to you? Who would you rather be? Most people, their gut tells them investor A. I mean, look at that. It's a perfect record, all wins. But the answer, the correct model, is investor B. That's what real sustainable investing actually looks like. You're never going to win every time. It's just not possible. The real game is making sure that when you win big, and when you lose small. The goal isn't perfection, it's net profitability. Investor B gets it. They cut the losers without hesitation and let the winners ride. And that is exactly why winners just don't waste their time on these things. They're not looking for some holy grail system that never loses. They know they can't predict the future, and they don't believe some guru has all the answers. And they have zero expectation of buying at the very bottom and selling at the tippy top. These are all just fantasies that come from chasing perfection. So instead of asking an impossible question like, what's the market going to do next? A winner asks a much smarter, much more powerful one. They ask, okay, given what's happening right now, how should I manage my investments? See the difference? It's a shift from the fantasy of prediction to the real-world skill of management. And that brings us to our final and maybe most important section. Investing isn't a single event. It's not a lottery ticket. It is a continuous, ongoing process. It's a craft that you have to learn, practice, and refine over a lifetime. The moment you buy something, that's not the end. That's just the starting gun. The real work is what the source material calls serial decision-making. Every single day, you have to look at what you own and make a fresh decision. And you better believe that deciding to do nothing, just to hold on, is just as much of an active decision as buying or selling. You have to justify it every single day. So, how long does it take to get good at this? You got to be realistic about it. We're talking about a profession here, right? Just like becoming a surgeon or an architect. You should expect to put in 5, maybe even 10 years to really learn the ropes and master the craft. There are no overnight successes here. And this right here, this might be the most practical piece of advice in this entire explainer. During that long 5 to 10-year apprenticeship, your #1 job is survival. You are going to make mistakes. We all do. The trick is to follow the rules we've talked about so you don't blow up your account while you're getting that priceless experience. So, we've covered a lot. Escaping the anchor of your purchase price, getting your ego out of the equation, understanding the brutal math of big losses, all of it. So the final question is for you. Now that you've seen how winners think differently, I want you to ask yourself, what's the very first mental trap that you are going to work on escaping? Thanks for joining me. You know, a lot of people look at the world of investing and think it's some kind of secret club, right? Like there's a magic formula only a few people know. But what if I told you it's not a mystery at all? What if it's just a profession, something that can actually be learned, practiced, and mastered? That's exactly what we're going to dig into today. We're going to break down the entire structure of a successful investor, piece by piece, pillar by pillar. So let's just tackle the big question right up front. What is this thing we call successful investing? Is it some secret art form that you need a special key to unlock? Or is it really just a big game of chance, a roll of the dice at a casino? I mean, it's easy to think that, especially when you see the wild wins and the devastating losses that make the headlines. Well, the truth is, it's neither. And honestly, thinking it's magic or pure luck, that's probably the single biggest mistake an aspiring investor can make. The reality is, successful investing is like building something solid. Think of it like a house. And any good house needs a strong foundation and sturdy pillars to hold it up. We're about to walk through the 6 pillars that can support a lifetime of building wealth. And that brings us right to pillar number 1, the absolute bedrock that everything else is built on: knowledge. I mean, think about it. You wouldn't hire a doctor who skipped medical school, right? So why would you try to manage your life savings without doing the same kind of deep, foundational work? This isn't about chasing hot tips. It's about developing a real, professional-grade understanding of your craft. So knowledge is a big word. What does it actually look like in practice? Well, for starters, it means understanding the actual mechanics of how the markets work, the nuts and bolts. It means having the right tools like fundamental analysis to figure out what a business is truly worth, and even the scientific parts of technical analysis to read market sentiment. It also means you got to be a bit of a historian so you don't repeat the mistakes of the past, and a student of psychology because human emotion drives so much of what happens. And finally, why reinvent the wheel? You study the methods of the greats who've already proven what works. And here's the thing. This isn't something you learn once and you're done. The best investors are lifelong learners. They build powerful habits. Just imagine the edge you'd get by reading one new substantive book on the markets every single month, or by making it a daily habit to read a major financial paper. And I mean really read it, the deep dive articles, not just skimming the headlines. That constant effort is what draws a very clear line between the professional and the amateur. All right, so you've laid the foundation with knowledge. That's fantastic. But you can't build a house without a blueprint. And that is exactly what our second pillar is, the investment plan. This is arguably the single most critical tool you will ever have for navigating the sheer chaos of the markets. So what exactly is an investment plan? Just think of it as a business plan for your money. It's your objective, rational guide. But its real power, the secret sauce, is that you create it before you're on the emotional roller coaster of a live investment. When the market is plunging and your gut is screaming at you to panic and sell everything, this is the document that brings you back to earth and back to logic. And this slide right here really just says it all. It shows the 2 completely different paths an investor can take. Without a plan, your decision-making is emotional, it's impulsive, it's reactive, and honestly, it's chaotic. You're just being tossed around by fear and greed. But look at the other side. With a plan, your actions suddenly become objective, consistent, strategic, and planned. You are the one in control, not your emotions. This is the fundamental difference between building wealth and just gambling. Okay, so you have the knowledge and you have the blueprint, but we all know that executing a plan in the real world is messy. You need something to keep you on the road when things get bumpy. That brings us to our next 2 pillars, which are deeply connected: experience and discipline. And let's be really clear about this one. You cannot learn to invest just by reading books. You have to actually do it. Experience is the process of putting your knowledge into action, making mistakes, and you will make mistakes, and learning from them. It takes years. There's just no shortcut. But going through that process is what forges true, unshakable confidence in your strategy. Not arrogance, but a deep, quiet understanding that you know what to do under pressure. This quote from Warren Buffett just nails the connection perfectly. The sound intellectual framework, that's your investment plan, which you built from your knowledge. And the ability to keep emotions from corroding that framework, well, that is the very definition of discipline. You see, you have to have both. One is pretty much useless without the other. So how do you actually build this kind of discipline? It's a process, not an event. First, your plan has to fit you. You can't just copy someone else's. Second, you have to understand it so deeply that you have complete faith in its logic. Third, you gain that all-important experience by testing it with real money. And finally, This whole journey leads you to a better understanding of yourself, your own psychological triggers, and how to manage them. We've built the foundation, and we've put up the guardrails. Now we get to the final two pillars, and I like to think of these as the superpowers that truly unlock your long-term potential: patience and having a winning mindset. Now, we all heard about compound interest in school, but it's hard to really grasp its power until you see a visual like this. Look at the chart. The growth in the early years is steady, it's nice, but it's nothing special. But then look what happens down the road. It's not a straight line, it's a rocket ship. That exponential curve is the real magic of building wealth, and the only ingredient you need to unlock it is time. Patience isn't just a virtue here, it's a mathematical necessity. So this brings us to a crucial, hard truth. We live in a world that craves instant gratification, but the market couldn't care less about that. If you're looking for a get-rich-quick scheme, you're not investing, you're speculating, and the odds are stacked against you, just like in Vegas. True investing is a get-rich-slowly process. It rewards patience, and it absolutely punishes haste. And this all leads to our final and maybe the most critical pillar of all, your mindset. At the end of the day, investing is a game that is played between your ears. You're constantly forced to make decisions with incomplete information and uncertainty all around you. Your character, your emotional resilience, your ability to stay calm when everyone else is panicking, that becomes your greatest asset. It's the mental fortitude that allows you to execute your plan with discipline over the long periods of time required for patience to pay off. So, we've walked through all 6 of the essential pillars. You can see it's not about one single trick or chasing a hot stock tip. It's about systematically building a professional practice. It's about constructing a stable structure that can withstand the inevitable storms of the market and support your long-term goals. Let's just recap them one last time, because it's how they work together that matters. It all starts with knowledge. You use that knowledge to build a detailed investment plan. You gain experience by applying that plan in the real world, which in turn forges the discipline to stick with it. And all of that is amplified by patience, which lets compounding work its magic, and it's all held together by a winning mindset. You see, they're all connected. A weakness in any one pillar compromises the entire structure. And that's the framework. It's clear, it's logical, and it's proven. The only thing left to do is to start building. So I'll leave you with this question. As you look at these 6 pillars, which one in your own investing practice needs the most work? Which one are you going to start reinforcing today?
All right, let's talk about investing. We're going to dive into how you can build a real roadmap for your investments. The idea here is to take all that, that chaos and confusion that so many of us feel and turn it into a clear, step-by-step journey that's actually designed to get you to your financial goals. I mean, seriously, have you ever felt like this? Like you're just investing in the dark? You're putting your hard-earned money out there, but deep down, you're not 100% sure if you're even on the right path. Are you just guessing? Kind of reacting to whatever the news is shouting about that day? It's a feeling a lot of people have, and let's be honest, it's incredibly stressful. And that feeling, it leads to some pretty big problems. You look at your portfolio and it just feels like, well, a random collection of stocks, right? There's no real strategy holding it all together, no sense of direction. And that kind of chaos, well, it brews anxiety. And worse, it usually leads to making some really bad decisions, especially when the market gets shaky. But what if you could change all that? What if, instead of chaos, you had a blueprint? An architect would never, ever dream of building a house without a detailed plan. So why on earth should we try to build our wealth without one? The whole goal here is to show you exactly how to create that blueprint so you can turn all that market complexity into a plan that's clear and, most importantly, something you can actually act on. So this is the big idea right here, an investment roadmap. It's not about trying to pick the next hot stock. Forget about that for a second. It is the big picture structure. It's the framework that makes sure every single decision you make, every single one, fits into your larger strategy. This is what's going to keep you from getting totally lost in all that day-to-day market noise. Okay, so here's our game plan for today. We'll start by talking about what it's like investing without a map. Then we'll get into creating the blueprint itself. We're going to lay the foundation, build the core framework, do a final walkthrough, and then finally, we'll talk about how you can start drafting your own plan. Sound good? Let's jump in. All right, first things first, laying the foundation. Every great building, it all starts with a rock-solid foundation. It's probably the most critical part of the whole structure, even though you can't even see it once it's done. And it is exactly the same for your investment plan. Before you even think about specific stocks or funds, you absolutely have to get this part right. And that foundation, It really rests on two main pillars. It's actually pretty simple. First, you've got to know what you're building. What's the goal? That's your objective. And second, you need to decide how you're going to build it. That's your philosophy. And these two things, they have to work together perfectly. So let's get down to brass tacks. Your objective, it has to be more than just, I want to make more money. That's not a plan. You have to ask yourself a very direct question: what return on capital am I actually aiming for? Put it this way, for every dollar you invest, what do you expect it to earn for you per year? Is it 8%, 12%, 15%? When you set a clear, measurable number like that, you create a North Star for yourself. It guides everything.
Okay, next up is your philosophy. And you know what? The key here is to keep it simple. This is your core belief. It's the big idea about how you think you can win in the market. For example, are you a value investor? Like a Warren Buffett type, always hunting for great companies that are on sale? Or maybe you're a growth investor, betting on those innovative companies that could just take over the world, even if they seem a little pricey today. Whatever it is, that one big idea, that's the engine that's going to drive you toward your objective.
So our foundation is poured and set. Now it's time to start building the framework. This is where we have to deal with the real world, with all the messy complexities of the market. We need to put up a structure that doesn't just support our goals, but also protects our money from all the challenges that are, inevitably going to pop up. Look, let's be totally honest with each other. Investing has risks. There's just no way around it. But a great plan doesn't stick its head in the sand and ignore those risks. It confronts them head on. For every single potential threat out there, whether it's a market crash, a company going belly up, or crazy inflation, your plan needs to have a specific strategy ready to go. That's the huge difference between being proactive and just reacting to chaos. This right here, this is the nuts and bolts of your framework. It's the practical how-to part. Your plan absolutely has to have a system for answering these 4 questions. First, how do you even find good investments? Second, what are your rules for choosing the right ones? Third, how do you actually make the investment? And fourth, and this is a big one, how are you going to manage it over time? You need answers for all of these.
Okay, so let's say the blueprint is done and the structure is up. Now it's time for the final walkthrough, just like you would with a new house, right? This is where we step back, look at the whole plan, make sure it all fits together, and then, and this is key, we look for some real-world proof that this kind of thing actually works.
And before you put a single dollar to work, you need a summary. Just think of it as your one-page cheat sheet. With so many moving parts in an investment plan, having this summary is absolutely essential. It's what keeps your main objective, your core philosophy, and your key strategies right in front of your face, so you don't get sidetracked by all the noise. But here's the thing, and it's so important. A plan on a piece of paper, it's just a theory. That's all it is. Real confidence, that only comes from seeing how it actually works out in the real world. Experience, whether it's your own or learning from somebody else's, is what turns ideas into actual wisdom. And a fantastic way to get that experience without getting burned is to study what's happened in the past.
And this is a perfect way to do it, by digging into case studies from a really fascinating time, the bull market that ran from 2003 to 2007. Now, why that period specifically? Well, it was a time of incredible growth and optimism right before the whole system got put through the ringer in the 2008 financial crisis. The lessons you can pull from that era, what worked and what really, really didn't, are just priceless today.
Just think about what looking at case studies like this lets you do. You can basically get inside an investor's head. You can see the exact same charts they were looking at. You can understand the calculations they were doing. And you can follow their entire thinking process step by step. This is how you can stress test your own ideas and learn these critical lessons without having to risk a single penny of your own money first. It's like a flight simulator for investing. Okay, we have walked through the entire blueprint. We've laid the foundation, we've built the framework, we've done the final inspection. So now the spotlight turns to you. It's time to start taking all these concepts and thinking about how you're going to turn this abstract blueprint into your own personal reality.
If you only take one single thing away from our time together today, please let it be this. Without a structured plan, investing is basically a gamble. It's a trip to the casino. But with a plan, it becomes a deliberate act of construction. You stop being a gambler and you become the architect of your own financial future. Every single move you make has a purpose.
So I'm going to leave you with this one question. Just forget all the complexity for a minute, forget all the details. Just think about this. What is the very first step in your blueprint? Is it finally sitting down and defining your objective?
Is it writing out your core philosophy on a single sheet of paper? Whatever it is, that's where your journey from chaos to clarity really begins. So what's the first brick you're going to lay?
All right, let's jump right in. We're going to do something a little different today. Forget all the abstract, high-level theories for a minute. We are getting personal. We're basically going to look over the shoulder of one single investor and dissect their investment plan, and it is a highly focused plan. We'll look at the assets they chose, and just as importantly, the ones they flat out ignored. And then we'll see how it all performed through some pretty serious market booms and busts. Honestly, it's a masterclass in discipline, and the results, well, they're pretty stunning. So, here's how we're going to break this down. First, we'll look at how this investor actually framed their whole plan from the get-go. Then, we'll dig into the specific assets they decided to play with. After that, we'll see the target they set for themselves, a really crucial piece. And then, the moment of truth, seeing the plan in action with real hard numbers. And finally, we'll wrap up by pulling out the biggest lessons we can all learn from their journey. Okay, let's get to it. Part 1, framing your plan. Now, the source material for this whole case study makes a really powerful point. It says that before you even think about buying a single stock or asset, a solid investment plan has to start by answering 2 fundamental questions. And here they are, simple but so important. Number 1, which markets will I participate in? And number 2, what is my performance target? Now, these are not just warm-up questions, okay? They are the absolute foundation of your entire strategy. If you don't have clear answers to these, you're really just guessing. And as we're about to see, this particular investor's answers define everything that comes next. So that brings us right into our second section, choosing your asset class. What I find so compelling about this strategy is just how sharp and focused it is. It's really defined just as much by what this investor deliberately chose to avoid as by what they decided to invest in. It's a strategy of exclusion. So how did they make their choice? Well, they looked at the data. This table here shows the numbers that were guiding their thinking. This is looking at 20-year average returns leading up to 2007, and you can see Australian stocks were kicking out a very solid 11% per year. Based on this, the investor basically came to the conclusion that, hey, I don't need to overcomplicate this. I don't have to look all over the world to find a decent return for my long-term goals. And that data led to this simple but incredibly powerful decision. Based on those returns and, this is key, their own expertise, they defined their entire investment universe as just 2 things: Australian stocks or cash. That's it. Nothing else. Now, that is a radical level of focus, right? The upside is huge: simplicity and the chance to become a true expert. The downside, of course, is you're putting a lot of eggs in one basket. But this single decision is the key to their whole strategy. So if they're only in stocks or cash, what did they throw out? Well, first on the chopping block, bonds. And I gotta say, the reasoning here is just refreshingly honest. As you can see, they just see it as a difficult market. They openly admit they don't have deep personal expertise in it. And maybe most importantly, they just don't like it. There's no passion for it. It's a perfect example of staying in your lane, sticking to your circle of competence. Okay, what about international stocks? I mean, this is where most people go for diversification, right? But again, our investor here deliberately stays away. And their reasoning, it's all about managing risk. They point to higher risks from not having enough knowledge in unfamiliar markets, not having the right information, taking on currency risk you don't need, and let's be honest, the administrative and tax headaches are a nightmare. So the final conclusion was, if the long-run returns are pretty similar to what I can get at home, why on earth would I take on all that extra complexity? And the last big asset class they rejected is other real estate. Now, beyond their own home, they just don't invest in it. And the logic is perfectly consistent with everything else we've seen. Their expertise, their competitive advantage, is in the stock market. And that's where they believe they can get the best returns. Again and again, it all comes back to one thing: focus. All right, so we know the playing field: Australian stocks or cash. Simple. Now it's time to tackle that second core question from the very beginning. Section 3, setting a performance target. And this isn't about plucking a number out of thin air. It's about the art of setting a clear, actionable, and this is the most important part, a realistic goal. And the source material gives us this simple but really powerful 3-part framework. Any goal worth having has to be specific, measurable, and realistic. These vague goals like, I want to make a lot of money, or I just want to beat the market, they're pretty much useless when it comes to a disciplined plan. And here it is, their specific target: an average Annual return of 12.5% pre-tax. It's clear, it's simple, there is zero ambiguity. So does 12.5% actually hold up against that three-part test? Well, let's see. First, is it specific?
Yep, it's an absolute number. Can't get more specific than that. Second, is it measurable? Absolutely. Performance can be checked and verified against the records. And third, is it realistic? This is the big one. It's definitely ambitious, no doubt about it. But it's still below that 15 to 20% range that the best of the best professional managers in the world aim for. So you could call it a stretch goal, but it's not a daydream.
Now, a real quick technical point, especially for our viewers outside of Australia. The returns we're about to look at are pre-tax, but they include something called a franking credit. All you need to know is that this is a feature of the Australian tax system. It's designed to stop company profits from being taxed twice. Just think of it as part of the total return an Australian investor gets. Okay, moving on. Okay, the plan is locked in. Australian stocks or cash with a 12.5% average annual target. Now for the fun part, the moment of truth. Let's dive into Section 4, the plan in action, and take a look at the actual track record. This is where the rubber meets the road. So, this first table shows their yearly return measured against that 12.5% target. And the biggest thing to notice here is the volatility. It's a bumpy ride. They do not hit that target every single year, not even close. In weaker market years, they fell short, but then you get a boom year like 2006/07, and they just absolutely crushed it with a 45% return. This is perfect proof of why the goal has to be an average over many, many years. But this is where the strategy really shows its power, the comparison against the market index. Now pay very close attention to the downturns. Look at 2007/08. The market falls over 12%. This portfolio was only down 5%. And it gets even better. Look at the first 5 months of the 2008 financial crisis. The market absolutely crashed, down almost 30%. This investor, they were actually up 2.6%. That is incredible outperformance, right when it matters most. So what does all that outperformance actually look like in dollars and cents? Well, this slide tracks the growth of a hypothetical $100,000. And that difference column on the right, that tells the whole story. By the peak of the market in '07, this plan was ahead by over $136,000. But then, after the crash, when protecting your capital was everything, that gap widened to an incredible $223,000. That's the power of compounding, mixed with real downside protection. And if you want to see the final result in one stark image, here it is. After 8.5 years, a period that included the dot-com bust, a massive bull run, and the global financial crisis, this disciplined plan turned $100,000 into more than $380,000. Meanwhile, a simple passive index fund over that same time would have grown to just $157,000. I mean, the active plan more than doubled the passive outcome. The difference is just staggering.
So yeah, a truly impressive track record. But the numbers themselves are really only half the story. So for our final section here, let's try and pull out the key lessons we can take away from all this. And that includes both the underlying wisdom of the approach and a few important technical details.
The first, and maybe the most important lesson, is a healthy dose of humility. And this comes directly from the investor themselves. They are crystal clear that these past results don't guarantee a thing about the future. And I absolutely love this quote from the source material. Investing is a long race. Leading the first lap proves very little, but is a pleasing sign. I mean, that is just the perfect long-term perspective. Okay, one final technical point, and this is for those of you who really appreciate the details of measuring performance. To make sure the numbers are totally accurate and honest, the investor uses a method called time-weighted average capital, or TWAC. This is really important because it properly accounts for any money that gets added to or pulled out of the portfolio during the year. It basically prevents new cash from messing with your real percentage return. And this slide just gives you a quick example of how that works. You can see that when capital is taken out or added back in, the calculation adjusts for it. The whole goal is to find the effective amount of capital that was actually at work for the entire year. So in this example, the final number used to calculate the return isn't the start or end balance, but that time-weighted average of about $1,005,000. It's really just a method for keeping the math honest. So what's the big takeaway from all this? We've just walked through one investor's incredibly clear, focused, and disciplined plan. They answered those two core questions right at the start, they stayed firmly inside their circle of competence, they set a realistic target, and they executed it with patience. Which brings us to the final and really the most important question of all. We've just seen their plan. What does your plan look like?
You know, in investing, we're all looking for that edge, right? That special something that gives us an advantage, a way to get consistent returns. But what if the most powerful edge isn't some super complex formula, but an idea that's actually, well, surprisingly simple? So today, we're going to dig into a single powerful concept that could totally change how you approach the market. Let's get into it. Yeah, you pretty much have to start here with this quote. I mean, think about it. Warren Buffett famously sat out the entire dot-com boom because he flat out admitted he didn't get what these companies actually did. The greatest investor of our time built his entire fortune not on complexity, but on a foundation of just profound simplicity. And that's the perfect jumping-off point for what we're about to uncover. And that's a really fair question, isn't it? If all the legends of investing are preaching simplicity, why do we get hit with all these super complex models and jargon that feel like you need a PhD just to understand them? The whole industry tells us to find an edge, but it often feels like the path to get there is made to be as confusing as possible. Well, this slide really gets to the core of it. There's this myth that just won't die in the world of finance, that for a strategy to really work, it's got to be complicated. We just assume that the big money is made with these secret formulas that the average person could never figure out. Even the pros, the analysts, tend to lean into complexity, maybe, as our source material says, to blind us with science. Man, this quote just nails that mindset perfectly. The author of the book we're looking at says he gets this question constantly. After he explains his simple, clear strategy, people just don't believe him. Their first reaction is, okay, I get that, but where's the real secret? What do you teach in the advanced class? It's just so hard for us to accept that what actually works can be that straightforward. Okay, so how do we break down this myth of complexity? Well, the key isn't buried in some secret advanced seminar. It's all about unlocking a really powerful principle that doesn't just apply to stocks, but to pretty much everything in life. You've probably heard of this one before, right? The Pareto principle. You know, the 80-20 rule. It's a simple idea, but it's incredibly profound. It just observes that in almost any area, the huge majority of your results come from a tiny minority of your efforts. Think about a business where 80% of the sales come from just 20% of the customers. Your whole goal becomes finding and focusing on that vital 20%. And this chart just makes it crystal clear, doesn't it? Look at that giant 80% slice of results. All of it comes from this little, focused 20% slice of inputs. And the implication of this, I mean, it's just staggering when you think about it. If you can just figure out what that 20% is and focus all your energy there, you can get most of the results with a fraction of the work. Okay, so what does this actually look like in our world, in investing? Well, the Pareto principle is saying that the lion's share of your profits, maybe 80% of them, are probably going to come from just a tiny handful of your best ideas. All that other stuff, the endless hours of research, the constant tweaking of your portfolio, that might only be contributing to the least important 20% of your gains. And this is the million-dollar question right here. If we buy into this idea that only a few of our actions really move the needle, then what are they? What is that crucial 20% in the stock market that we should be pouring all our energy into? The answer to this is the simple, big idea we're here to talk about. All right, here we go. The answer isn't some revolutionary, brand new discovery. Nope. Instead, the real magic, the actual edge, isn't some crazy new invention. It's about taking two powerful, proven ideas and snapping them together to create a single, unified strategy. And let's be super clear about this. We're not trying to reinvent the wheel. The author doesn't claim to have invented either of these individual ideas. The secret sauce is in the combination, in taking two proven elements and using them together as one incredibly powerful filter. Okay, so here they are, the two steps. It really is this simple. Step one is the what to buy. First, you find a really solid investment-grade company that's fundamentally cheap. But, and this is key, you don't buy it yet. You wait for step two, the when to buy. You have to make sure its price chart is already heading up. Both conditions are non-negotiable. Value first, then confirmation from the trend. And that right there, that two-part filter, that's the edge. That's the whole ballgame. The author argues that the most successful investors find one simple, powerful idea just like this, and they hammer it over and over again. They don't get distracted. They don't chase shiny objects. Everything they do is in service of this one core idea. Okay, so let's dig in. Why does this particular combo work so well? I mean, why not just hunt for cheap stocks? Or, just chase stocks that are on a tear?
The real power comes from demanding that both things are true at the exact same time. Let's break down why. This table breaks it down perfectly. On one side, you've got the what to buy. That's classic value investing, straight out of the Benjamin Graham playbook. Find good businesses on sale. On the other side, you have the when to buy, which comes from the world of technical analysis, guys like Stan Weinstein, who focus on price trends. You're combining value with momentum. Basically, you find a great deal, but you wait for the market to tell you, hey, you're right, before you pull the trigger. You see, that second piece, the price trend, that's the absolute key. It's the critical overlay. And why is that? Because there are always going to be people who know more than you do. Think about it. Long before a story hits the news, the people in the know, the smart money, they're already making their moves. And that is what starts to push the price. The trend is their footprint. So this is why the price trend becomes your best friend, your ultimate filter. A stock's price basically reflects everything that's known about it. So if a stock looks cheap on paper, but the price is actually dropping, that's a huge red flag. The market is screaming at you that something's wrong. This is how you avoid those dreaded value traps. And hey, let's be real. It's just common sense. Your money only grows if the price goes up. By waiting for an uptrend, you're just putting the wind at your back. I really love this slide because it just lays it out in black and white. On the left, you've got a stock with a fantastic story, but the price is sliding down toward the bottom right corner of the chart. On the right, same great story, but the price is climbing toward the top right. Which bet would you rather make? It's pretty obvious, right? You always want to be on the side where the market is already voting with its dollars in your favor. All right, let's wrap this up and boil it all down to something you can actually use right now. An actionable mantra, a simple rule to stick in your head that can guide every single decision you make from this day forward. Just take a second and read this. Let it really sink in. This is the author's personal vow. It's a commitment to stop trying to catch falling knives, to stop fighting the tape, to stop arguing with the market. No matter how convincing the story is, no matter how cheap the stock looks, if the price is heading down, you just walk away. End of story. You got to start thinking of the price chart as the ultimate lie detector. It just cuts through all the hype, all the stories, and even your own hopes and biases. So if you're convinced a stock is the deal of the century, but the price just keeps bleeding out, the chart is telling you something really important. Either you're wrong or someone out there with a lot more capital knows something you don't. And in either case, your job is to listen. So this is it. This is the entire big idea boiled down to one simple sentence. You are looking to buy cheap stocks that are going up, and you are looking to avoid or sell stocks that are going down. That's it. That is the guiding principle for everything. Just one. That's it. This is that one simple idea. This is the 20% that gets you 80% of the results. And according to the author, this wasn't an overnight thing. It took him years to really get this into his DNA, to fully internalize it. But now, it's not just one of his ideas, it is the idea. So, I'm going to leave you with this one last thought. Go pull up your own portfolio, right now. I'm sure every single stock you own has a great story behind it. That's why you bought it, after all. But for just a second, forget the stories, forget why you bought them. Just look at the charts and ask yourself one brutally honest question. Which way is the price actually trending? Because the answer to that question, that might be the most profitable thing you do all year. You know, if you're an investor, you get it. There are no sure things. The simple truth is, if you want to earn a return, you have to take on risk. It's not some big, scary monster you need to avoid. Really, it's just the price of admission. So the real question isn't if you'll face risk, it's how you're going to face it. So let's break it down. This quote right here, this is the foundation for everything we're about to talk about. See, risk isn't just this boogeyman in the closet, it's the actual engine of your potential returns. I mean, think about it. If an investment was a 100% guaranteed thing, there'd be no profit in it, right? Its value would just be fixed. So the only way to really get ahead is to understand the risks you're taking and manage them better than everybody else. So here's our game plan for how we're going to do that. First, we're going to redefine risk, but from your perspective as an investor. Then we're going to introduce the 4 key faces of risk you absolutely need to know: the overall market, the individual company, the danger of debt, and the challenge of liquidity. By the end of this, you're going to have a really powerful framework to see and manage the real challenges in your portfolio. All right, first things first. You know, how we define a problem pretty much dictates how we try to solve it. And when it comes to investment risk, man, there is a huge disconnect between the academic world and the real world. You know, the one where your actual money is on the line. And this slide just nails that disconnect. In academia, risk is defined as volatility, the whole swing of a price, both up and down. It's neat, it's tidy, you can plug it into a nice formula, but let's be real, none of us are losing sleep when one of our stocks shoots up. That's the whole point. For us, risk is pretty much a one-way street. It's that gut-wrenching fear that our investment is going to go down and only down. And when you dig into that feeling, it really boils down to two main fears. The first one is that the price will fall after you buy, which is painful for sure, but it could just be a temporary setback. The second one, though, is way more terrifying. The fear that the business itself just goes to zero. A total, permanent loss of your money. See, one is a bad day at the office, the other is game over. And understanding that difference is absolutely crucial. So to properly manage these fears, we need to understand what causes them. And this right here, this is our roadmap. We can actually categorize all the things that cause losses into 4 distinct groups, or as I like to call them, the 4 faces of risk. Let's meet the first one. First up, we've got market risk, and this subtitle is the perfect analogy, the rising tide. I want you to picture the entire stock market as a giant ocean, and every single stock is just a ship floating on it. So, market risk is the tide. When the tide of general market sentiment is rising, most ships, meaning most stocks, are going to go up with it. And when that tide goes out, most ships are going to fall, no matter how well built they are. This is the risk that just comes from being in the market. It's the big picture stuff, macroeconomic forces, overall investor mood, the whole shebang. So, how in the world do you manage a risk that affects everything? This is a super important point. You can't diversify it away. Owning a whole fleet of different ships doesn't help you one bit if the entire ocean level is dropping. The only real defense against market risk is asset allocation. It's about making a deliberate choice. How much of your money are you going to expose to the ocean at all? And how much are you going to keep safe on the shore, sitting in cash? Okay, so if market risk is the tide, what about the individual ships themselves? Well, that brings us to our second face of risk, specific risk. And this is all about the fortunes or misfortunes of one single company. You know, even when the tide is high and the sun is shining, an individual ship can still spring a leak and sink. That's specific risk. A company can have a terrible earnings report, a massive product failure, or even go bankrupt while the rest of the economy is humming along just fine. This risk has absolutely nothing to do with the overall market and everything to do with the company itself. Now, the good news is, unlike market risk, you have a lot of control over this one. It really comes down to a 3-part strategy. First, selection. You do your homework to pick the most seaworthy ships you can possibly find. Second, diversification. You never ever bet everything on a single boat. You spread your capital across a whole fleet. And third, position sizing. Even with your absolute favorite ship, you limit how much you stake on it. This makes sure that if one ship does go down, it doesn't take your entire portfolio down with it. And now for our third face, financial risk. This is what we call the debt trap. And it's where things get both really exciting and incredibly dangerous. This is the risk that comes from using borrowed money, what the pros call leverage. I want you to think of leverage like strapping a rocket engine to your ship. When you're right, it amplifies your gains, and man, you move at incredible speed. But it is a brutal double-edged sword, because that same rocket power works in reverse. A tiny mistake, a small drop in value, can be magnified into a catastrophic loss that could wipe out your entire investment, and then some. And this kind of risk can sneak into your portfolio in 2 ways. The first is obvious, personal leverage. That's when you borrow from your broker, use a margin loan, that kind of thing. But the second, and this is the one people often overlook, is corporate leverage. When you invest in a company that is itself drowning in debt, you are taking on their financial risk. Even if you paid 100% cash for your shares, their debt is now your problem. You know, I've seen this play out multiple times in my career, from the crazy debt binges of the 80s all the way to the financial crisis. And this quote, it really hits home. The market just has this brutal way of teaching and reteaching this lesson about the dangers of too much debt. And forgetting that lesson is just an open invitation for disaster. Frankly, it's why I now have an ironclad rule. I check a company's balance sheet for too much debt before I even think about anything else. And that brings us to our final and maybe the most overlooked face of risk.
Just imagine this for a second. You've done everything right. The market is stable, you picked a great company, it has no debt. But then one day, you need to sell. The only question that matters at that moment is, can you? This is liquidity risk. Simply put, liquidity risk is the danger that when you want to sell your investment, you can't find enough buyers at a fair price. Or, on the flip side, when you want to buy, you can't find enough sellers. It's the risk of getting stuck in an investment, unable to get your cash out when you need it most. Now, here's a really interesting point about this. Liquidity isn't some absolute thing. What's a highly liquid stock for a small private investor like you or me might be completely illiquid for a giant hedge fund. It all depends on the size of your investment compared to the size of the market for that particular stock. So what makes an investment liquid or not? Well, there are a few key things to look for. The most obvious is just trading volume. Are thousands of shares traded every day or just a handful? Next, you got to check the ownership. If one family or one institution owns 80% of the company, the actual float of shares available to trade might be tiny, which makes it really hard to get in or out. And finally, like we just said, your own portfolio size matters. The bigger you are, the harder it is to move without making waves, which, funny enough, actually shrinks the number of stocks you can invest in. So there you have it. Market, specific, financial, and liquidity. The four faces of investment risk. And this right here is the ultimate takeaway. You can't eliminate risk. It's impossible. But by giving these dangers a name, by separating them out into these distinct categories, you move from this state of vague anxiety to a position of clarity and control. Naming your risks truly is the first step to taming them. So I'll leave you with this question. Now that you can see these four faces clearly, which one have you been ignoring? Is it the market tide, the individual ship, the hidden debt, or the emergency exit? Being honest with yourself about that, well, that's the single most important step you can take right now to become a smarter, more successful investor. Thanks for your time. All right, let's talk about building real wealth. Look, we all know the stock market is one of the most powerful ways to do it, but I've been at this a long time, and I can tell you it's a classic double-edged sword. You've got incredible growth on one side and gut-wrenching risk on the other. The real challenge, the thing that separates the people who succeed long-term from those who don't, is learning how to manage that risk. And let's be clear, this isn't about avoiding risk. That's a fool's errand. It's about having a playbook, a real strategy to navigate it. So let's just dive right in with a question that gets to the absolute heart of the matter. You know, most investors who wash out of the market, they do it because they keep making the same two fundamental mistakes. I call them the two greatest sins of investing because they basically guarantee you'll do the exact opposite of what you're supposed to. You end up buying high and selling low. The entire playbook we're about to go through is designed to build a defense against ever doing that again. And this slide here, it just lays it out so clearly. You've got the beginner investor, right? They're driven by FOMO, fear of missing out. They see the headlines, they hear the hype, and they finally jump in with both feet right near the top of a rally. And then, when the market turns, they have no plan. They just freeze. Then they hope. And finally, when the pain gets too much to bear, they sell in a total panic near the bottom. The experienced investor? They're living in a completely different world. They're cautiously buying when things look terrible, and everyone else is running for the exit. And they are systematically selling when the party is in full swing. They are quite literally taking the other side of the beginner's trades. So to make sure you're on the right side of those trades, we're going to walk through this entire playbook. First, we'll nail down your investment philosophy, the why behind what you're doing. Then we'll get into how to read the market's mood, its psychology. After that, we'll look at specific tools to confirm what we're seeing. And finally, we'll tie it all together into a concrete, rules-based strategy for getting in and getting out. And we'll wrap up with the single most important question you can ask yourself. Okay, before we even think about tactics, you absolutely have to know what game you're playing. Your investment philosophy, well, that's your North Star. It's what guides every single decision, especially when your emotions are trying to take over. And for what we're talking about today, it really comes down to two very different schools of thought. So on one side, you've got passive investing. This is the whole time in the market approach. And the idea is powerful. You buy something like an index fund and you just hold on. Through thick and thin, you let time do the heavy lifting. But on the other side, you have active investing, or what some people call market timing. The belief here is that there are clear periods of high risk and low risk, and you should change your stock exposure based on that. The playbook we're going through is firmly in this active camp. The goal isn't to be a day trader, not at all. It's to be fully invested when the odds are stacked in your favor, and mostly in cash when they're not.
Now, the first and maybe the most powerful tool in this whole strategy isn't some crazy algorithm. It's about understanding people, market psychology. A long time ago, Charles Dow figured out that markets move in these cycles driven by emotion. He noticed that bull markets don't just go straight up. Nope, they unfold in three distinct, very recognizable phases. If you can learn to see these, it's like having a roadmap for the entire journey. So bull phase one, you have to understand this begins in the wreckage of the last bear market. The news is still awful, people are losing their jobs, and the general public is just completely disgusted with stocks. But here's the telltale sign for smart investors. The market stops going down on bad news. A terrible economic report comes out, and the market just shrugs it off. Everyone dismisses this first rally as just a bear market rally, but it's right here, in this climate of total disbelief, that the best opportunities are found. Then we move into phase two, and the whole picture just changes completely. This is the long, steady, orderly climb. The economic recovery isn't a question anymore. It's happening. Companies are making more money. People are getting hired. Confidence is coming back. This is usually the longest and, frankly, the safest part of the whole bull market. The trend is your friend, and it's just the easiest time to be an investor. And this is the danger zone. Phase three is when the party has gotten completely out of hand. The public, who were terrified back in phase one, now feel safe enough to rush in. You hear stories about people quitting their jobs to trade stocks. The news is just full of market hype, and you start to hear those four most dangerous words in investing. It's different this time. When your neighbor starts giving you stock tips, that's when you know risk is at an absolute peak. This is the time to be looking for the exit, not the entrance. And you know what they say? After the party comes the hangover. Every single bull market is followed by a bear market. It's just the cycle of greed turning into fear. And just like the bull, the bear has its own three phases. Recognizing these is absolutely critical for the most important job an investor has, preserving your capital. I mean, what good is it to make a fortune if you just give it all back on the way down? The bear market, it usually starts quietly. It's not a big crash. It's more like a change in character. And here's the mirror image of what we saw at the bottom. The market stops going up on good news. A company reports record profits, and the stock barely budges. Or maybe it even goes down. The public, they see this first dip as just another buying opportunity. They have no idea the tide has turned. Meanwhile, the smart money is quietly slipping out the back door. Now, this is the long, grinding reality check. This is where the bad economic news finally catches up with the market's decline. You get an official recession, and companies start lowering their forecasts. This phase, it really tests you. You get these sharp, violent rallies that suck people back in. We call them sucker rallies, right before the market rolls over and hits a new low. Those superstar stocks from the bull market, this is where they often crash and burn. Phase three is just maximum pessimism. This is the final, gut-wrenching washout where all hope is gone. The news is terrible, unemployment is spiking, and some people are literally being forced to sell good companies just to raise cash. It's distress selling. But it's in this darkness, when it feels like it's never going to end, that the seeds of the next bull market are sown. Patient, professional investors start quietly buying from all the people who just can't take the pain anymore. Okay, so understanding the market's mood gives us the big picture, the context of where we are. But to really make good decisions, we need to add some more objective tools on top of that. And look, these tools aren't about predicting the future. They're about confirming what those psychological phases are telling us, so we have something more concrete to act on than just a hunch. Our first tool is the Coppock Indicator. It was created for one very specific job, to tell us when a bear market has basically burned itself out and the period of highest risk is probably over. Now, it's really important to know what this is not. It's not going to pick the exact bottom, not to the day or the week. Its job is to identify a broad zone where it has become much, much safer to start looking for long-term buys again. Think of it as the market's all-clear signal. And the signal itself is just beautifully simple. The indicator is a line that moves above and below zero. In a bear market, it drops way down into negative territory. The buy signal happens the first time that line, after being below zero, hooks back up and starts to rise. That's it. It's like a pressure gauge that's been falling and falling, and the signal is that first moment that pressure starts to build again. It tells us the downward momentum is finally broken. Our second tool is the absolute foundation of all technical analysis, the concept of a trend. It's so simple, and that's why it's so powerful. A bull market is just a series of higher peaks and higher troughs on a chart. A bear market, a series of lower peaks and lower troughs. The big change, the confirmation, happens when the market clearly breaks out above a previous peak or breaks down below a previous trough. This simple observation is our final visual proof that the market's primary direction has changed. All right, now let's put it all together. This is where the rubber meets the road. We're going to combine everything: our understanding of the market's phases, the Coppock Indicator, and trend analysis to create a clear, rules-based plan. This is the actual playbook for getting in and getting out. So here's how you get back into the market. You don't just dive in all at once, you ease in as the evidence builds. Step 1. When you've identified you're in bear phase 3, maximum pessimism, you start to cautiously buy, maybe putting 20% of your capital to work in the strongest stocks. Step 2. When that Coppock indicator gives its buy signal, you get more confident. You increase to 40%. Step 3. When the overall market index confirms a new uptrend by breaking out, you move up to 70% invested. And finally, Step 4. After the first pullback and the new bull market holds, you can confidently go to 100%. See, it's a methodical process of deploying your cash as the risk goes down. And getting out is just as critical. The logic is just the reverse. As soon as you recognize the wild speculation of bull phase 3, you start taking chips off the table. Maybe you sell down to 70% invested. As the hype gets even crazier, you sell down further, maybe to 30%. The goal here is to sell into strength when everyone else is greedy, not in a panic after it's already falling apart. And finally, when the main market index breaks its uptrend, you sell what's left. You don't have to predict the top, you just follow the rules. This quote from Bernard Baruch, it's the perfect mantra for this exit strategy. Amateurs, they're obsessed with getting every last dollar out of a rally. Professionals, they're obsessed with keeping the money they've already made. Having the discipline to sell while the party is still going, to happily let someone else have that last, most dangerous 10%, that's what separates the pros from the amateurs. Selling too soon is just another way of saying selling smart. Now, there is an incredibly important rule here. When you're reducing your exposure, the natural thing to do is sell your biggest winners to lock in profits, and you hold on to your losers, hoping they'll turn around. That is a huge mistake. Your best stocks are your leaders for a reason. Instead, you should always sell your worst performers first. Cut the laggards. You are systematically removing the weaklings from your portfolio, not your strongest ones. So, we've laid out the entire framework. We've gone from a big picture psychology all the way down to a step-by-step plan. But I've learned that having a great playbook, well, it's not enough. There's one last, and maybe the most important, question you've got to ask yourself. Look, this active strategy, it takes immense emotional discipline. It's going to force you to buy when every fiber of your being is screaming in fear. And it's going to force you to sell when you're feeling on top of the world and greedy. You have to be able to follow the rules, not your gut. So, the ultimate question is a personal one. Does this approach actually fit your personality? Can you really do it when the pressure is on? You have to be brutally honest with yourself, because the best investment strategy in the world is completely useless if you can't stick with it. Is this your path, or would a simpler, passive approach actually serve you better? Only you can answer that. All right, welcome to the Explainer. You know, we all spend a lot of time worrying about the next big market crash. But what about that other danger? The one that can just quietly, absolutely wreck your portfolio from the inside out. I'm talking about the risk that one of your carefully chosen stocks suddenly takes a nosedive. That's called specific risk. And today, we're going to unpack a professional strategy to handle it. And believe me, it goes way beyond the usual advice you hear. So here's how we're going to tackle this. First up, we'll define exactly what this problem is. Then, we're going to dig into why the solution everyone talks about, diversification, can actually be a bit of a trap. And finally, we'll get to the real meat of it, this powerful combo of some flexible guidelines and just one, rock-solid rule that's all about protecting your capital. Okay, let's jump right in. First things first, before we can even think about solving this problem, we've got to put a name on it. We need to know exactly what we're dealing with. Now, let's be super clear here. This is not market risk. We're not talking about a recession or some big event that drags the whole market down with it. No. Specific risk is all about one single company. It's that moment when a company you own just completely misses its earnings. Or maybe that blockbuster product they were banking on turns out to be a total flop. Or boom, they get hit with some crazy out-of-the-blue lawsuit. It's the kind of risk that is totally unique to that one stock. So, what's the textbook defense against this kind of thing? Well, everyone and their brother will tell you to diversify, right? But, and this is a big but, it turns out the way most people actually do it creates this huge dilemma, especially if you're trying to do more than just match the market. Look, the idea itself is super simple. It makes perfect sense, right? Don't put all your eggs in one basket. The thinking is, if you just spread your money out over tons of different stocks, then if one of them fails, it won't be a total catastrophe. It won't sink the whole ship. But here's the trap. This quote here really nails it. If you spread your money too thin, you've basically just created your own kind of clunky, probably more expensive version of an index fund. Yeah, sure, you've minimized the risk of any one company blowing up your portfolio, but you've also pretty much guaranteed you're going to get, well, mediocre, average of the market results. And the slide really just lays out the raw math. It's fantastic. Okay, look at portfolio A on the left. You've got 100 stocks. Each one is a tiny 1% of your total capital. So let's say you hit a home run. One of your stocks doubles. Amazing, right? Well, your whole portfolio only goes up by 1%. To get a decent 13% return for the year, you'd have to find 9 of those massive winners. 9. Now, look over at portfolio B. It's focused, only 20 stocks. Here, each position really counts. A single stock doubling gives your entire portfolio a 5% boost. All you need is to be right twice to have a great year. Now, which sounds more achievable? Finding 2 great ideas or finding 9? It's a whole different ballgame. So this leads us right into the first piece of a much smarter solution. See, it's not about throwing diversification out the window. Not at all. It's about finding that sweet spot. That Goldilocks zone, Not too spread out, but not too concentrated either. Okay, so check this out. These are the author's guidelines for finding that just right balance. First, you put at least 2% of your capital into any single stock. Why? So that it's actually meaningful, so it can move the needle on your returns. But, and this is so important, you invest no more than 6%. That way, if one stock turns into a total disaster, it's not going to sink you. And what's cool is this structure kind of naturally pushes you to hold somewhere between, say, 17 and 30 stocks. It forces you to focus on your best ideas, but without being totally reckless. And I really want you to focus on the key word here, guidelines. These aren't rigid, unbreakable rules. They're flexible. Maybe you start a position small, and as you get more confident, you add to it. Or hey, maybe you've got a huge winner that's grown to like 10% of your portfolio. You can trim it back down to that 6% level. That flexibility is absolutely crucial, but it's only half the story. The other half, well, that's an ironclad rule. And here we go. This right here is the real secret weapon for managing specific risk. But to get it, you have to completely shift how you think about what's truly at risk when you put your money into a stock. This is a massive mental shift, so stay with me. Most people, when they put, say, 10 grand into a stock, they think they're risking 10 grand. Makes sense, right? But that's not how professionals look at it. Not at all. Your true risk is just the difference between the price you buy at and the price you've already decided you'll sell at if you're wrong, your stop loss. It's that preset point where you just say, okay, I was wrong, and you get out. That little slice, that's the only money that's actually on the line. So what's the rule? Here it is. It's firm, it's non-negotiable. You never risk more than 0.5% of your total capital on a single trade. Let me say that again. Not 0.5% of the position size, 0.5% of your entire portfolio. And yeah, this slide says everything you need to know. Remember those diversification numbers? Those were flexible guidelines. This 0.5% thing, that is an inviolate rule. It's the absolute core defense that makes sure a string of bad luck, and it'll happen, doesn't knock you out of the game. It keeps you alive long enough for your big winners to show up. I gotta say, I love this analogy. It's so true. So many people see a risk limit and they treat it like a target, like something they should push right up against. But the author's point is, no. It's a hard ceiling. It is the absolute maximum. Think of it like a safety barrier, not some kind of challenge. Honestly, most of the time, you should probably be risking even less. Okay, so this all sounds great in theory, but how does it actually work? Like in the real world? Well, what's interesting is this rule doesn't tell you what stock to buy. Nope, it tells you how many shares of that stock you're allowed to buy. Let's just walk through the example here. It makes it super clear. Let's say your total capital is $400,000. Okay, your maximum risk using that 0.5% rule is $2,000. Simple enough. Now you find a stock you want to buy at $12 a share. And you've already decided, hey, if this thing drops to $10, my idea was wrong and I'm out. So your risk on each share is exactly $2. And from here, the math is it's beautifully simple. You take that maximum dollar risk, the $2,000, and you divide it by your risk for share, the $2. And what do you get? 1,000. That means 1,000 shares is the absolute maximum number of shares you can buy for this trade, period. And here it is. This is the whole point. This method completely disconnects the size of your investment from the actual risk you're taking on. You see? In this case, you're putting $12,000 into the stock, which is 3% of your portfolio, totally within those diversification guidelines we talked about. But the actual pre-calculated capital at risk, it's only that $2,000, only 0.5% of your total. It's a brilliant way to think about it. So is that 0.5% number some kind of magic bullet? Is it the perfect number for absolutely everyone? Well, the author makes a really important and I think very honest point about this. You know what's really telling is when you look at how the author himself has done this over time. When he started out with a much smaller account, he was actually risking more per trade, sometimes up to 2%. He had to, really, to make the gains meaningful. But as his capital grew, up into the millions, that risk number he used per trade got smaller and smaller, all the way down to that 0.5% rule he follows today. So what does that mean for you? It means that 0.5% figure isn't some universal law you just have to copy and paste. It's a principle. Think about it. If you have a smaller portfolio, risking only 0.5% might mean your positions are so tiny that transaction fees just eat you alive. You have to adapt the principle to your own financial situation and, just as important, to your own personal comfort level with risk. And really, that's the ultimate takeaway here. This whole strategy, it's not about just blindly copying someone else's numbers. It's about understanding the logic behind it. The logic of separating flexible guidelines from those ironclad rules. It's about defining your true risk before you ever click the buy button, and then building a disciplined process that is tailored specifically for you, for your portfolio, and for your own financial journey. All right, welcome to The Explainer. Today we're going to look past the big, flashy market crashes and dig into 2 hidden dangers that can absolutely wreck your portfolio, sometimes without you even seeing them coming. We're talking about financial risk and liquidity risk, and we're going to use the playbook of a really seasoned investor to see exactly how to defend against them. So let's just dive right in with this question. I mean, we all get nervous about the big market meltdowns, right? But what about the sneakier risks? The ones that can quietly pull a great investment right out from under you, even when the rest of the market seems totally fine. Honestly, getting a handle on these is what really separates a resilient, long-term strategy from just, picking stocks and hoping for the best. Okay, first up, let's tackle financial risk. This one is probably the most straightforward of these hidden dangers, but don't let that fool you. It's all about the incredible power and the incredible danger of using borrowed money, the debt trap. Now, the definition seems pretty simple, doesn't it? The more you borrow, the riskier it gets. But the effects can be absolutely explosive. When a company uses debt, you'll hear it called gearing or leverage. It's like strapping a turbocharger onto the business. It can make things go incredibly fast, but it can also make the engine blow up spectacularly. Let's look at a quick example to see exactly how this plays out. So take a look at how this company is set up. It's got $10 million of its own money. That's the stockholders' funds. But it's gone out and borrowed $50 million. So it's operating with $60 million in total. You see what's happening here? For every $1 of its own money, it's using $5 of someone else's. That is the definition of a highly geared company. And this right here shows you the incredible double-edged sword of gearing. On the bright side, if the company knocks it out of the park and makes a $15 million profit, the return for the actual owners, the stockholders, is a massive 150%. But look at the dark side. If things go wrong and it loses $15 million, the stockholders get completely wiped out. Poof, their entire $10 million is gone. If they had no debt, that same loss would have been a survivable 25% hit. And that's the key takeaway. High debt magnifies everything, good and bad, but what it really does is it just destroys your margin for error. A small stumble, a bad quarter, things a debt-free company could just shake off can become a fatal blow for a company that's loaded up with debt. There's just no room to breathe. So how do you protect yourself from this? Well, the investor we're following has 3 very clear, non-negotiable rules. First, a personal one. He never borrows money to buy stocks, period. Second, he's very wary of companies that are already swimming in debt. His rule of thumb is to avoid any company with a debt-to-equity ratio over 60%. And third, he just stays away from the complicated stuff like options and futures. Those are basically leverage bets themselves and just add another layer of risk he doesn't want. All right, let's shift gears to the second hidden danger. This one's a bit more subtle, but it can be just as deadly. Liquidity risk. And this has nothing to do with how good a company is. This is all about the exit. It's the problem of being able to sell your investment and get your cash out when you decide it's time to go. Just imagine this for a second. You own a stock, and on your screen, it says it's worth a lot of money. Then some bad news hits, and you think, okay, time to sell. You go to your broker, you hit that sell button, and crickets. Nothing happens. There just aren't any buyers out there willing to pay a fair price. You're trapped. That feeling, right there, is liquidity risk. Now, you run into this problem most often with smaller companies, and it creates this classic dilemma. On one hand, you've got these small, nimble companies that have huge growth potential, right? They can double, triple, or more in a way that some giant corporation just can't. But on the other hand, they fail more often. And this is the key. Their stocks are often illiquid, meaning not many shares trade hands, and that makes them a potential trap. So let's just visualize this. Think of a huge blue-chip company we all know. Every single day, millions upon millions of its shares are bought and sold. It's like a giant, deep river of buyers and sellers. You could sell a massive position and it wouldn't even cause a ripple in the price. That is a liquid stock. Now, let's take a step down. Think of a good, solid, but smaller company. It trades most days, there's decent volume. As long as the market is behaving itself, you can get in and out without much of a headache. This is usually pretty safe, but you're starting to notice, the river isn't quite as deep. Okay, now here's where it starts to get really dangerous. This kind of stock might not even trade every day. There might be days with zero volume. If you decide you need to sell, you might be waiting a week, maybe longer, to find someone to buy your shares at a price that's even close to what you think they're worth. You gotta be extremely cautious here. And finally, you have the ultimate exit trap. This stock might trade like a few times a month. If any kind of crisis hits this company, forget it. It becomes almost impossible to sell at any price. You are completely and totally stuck. For most people, this is a level of risk you should just run away from. So we've gone through the danger of debt and the trap of illiquidity. How does an experienced investor pull all of this together into a strategy that actually works? Let's zoom out and look at the whole investment philosophy that ties these risk management ideas together. When you break it all down, the entire strategy really rests on three core pillars. First, being crystal clear about what kind of company you're even willing to look at. Second, defining exactly how you'll operate. In this case, only buying for the long haul. And third, having the right mindset. Thinking like an investor, not a gambler. What's really powerful about this approach is what it excludes. This isn't about finding the next hot thing. It's about drawing a line in the sand and saying no to the most speculative parts of the market. No profitless mining companies, no unproven tech startups, no brand new IPOs. By filtering all that noise out, the focus gets laser sharp on one thing: established, profitable businesses that you can actually understand. The second pillar is just this unwavering commitment to being a long-only investor. All that means is you're buying shares in a company because you believe it's going to succeed and grow over time. You are betting on success, not trying to profit from failure by short selling. And this isn't just some feel-good philosophy. It's a hard-nosed risk management decision. First, history is on your side. Over the long run, markets tend to go up. But the biggest reason is controlling your downside. When you buy a stock, the absolute most you can lose is the money you put in. But when you short a stock, whoa. If you're wrong and that stock takes off like a rocket, your potential losses are literally unlimited. It's a risk that just isn't worth taking. And this all leads to the final, and maybe the most important pillar, your mindset. There is a huge difference between being an investor and being a speculator. An investor is focused on the long term, on total return, and treats it like they're building a business. A speculator? They're just chasing a quick buck off short-term noise, more for the thrill of the trade than anything else. This playbook is all about being a business owner, not a gambler. So after breaking all this down, after looking inside this detailed playbook for managing these hidden risks, what's the big takeaway for you? How do you actually use this to build your own approach to the market?
Look, at the end of the day, the message is really simple. A durable, long-term strategy always starts with managing risk, not with chasing returns. It means you have to set hard, non-negotiable rules for yourself about debt and about liquidity. You have to be disciplined about what you say no to. And maybe most importantly, you have to treat this as a serious business, not as entertainment.
So, I'll leave you with this one final question to chew on. It's not about just copying someone else's rules. It's about sitting down and deciding what rules are going to define your plan. Because having those principles, well, that's the real foundation for building your own financial future. Thanks for joining me.
Have you ever felt like picking stocks is, I don't know, just a total guessing game? Like you're just throwing darts at a board? Well, today we're going to change that. We are breaking down a clear, repeatable system for selecting stocks, one that moves you from guesswork to a deliberate strategic process.
All right, so here's the game plan. We'll start with the core philosophy, this hybrid approach. Then we'll get into the whole value versus growth debate. From there, we'll learn how to spot the chart models for each, walk through a two-filter process to actually find these stocks, and then wrap it all up with how to make that final decision. So the entire foundation of this whole system, the thing that makes it tick, is built on this really powerful hybrid idea. We're going to be combining two totally different types of analysis to get a complete, kind of three-dimensional view of any potential investment.
Okay, so on one hand, you've got technical analysis. This is all about the when. It's looking at the stock's chart, the price action, to see if it's already moving up or if it's just about to start. Then, on the other hand, you've got fundamental analysis. This is the what. This is where you dig into the company itself, its health, its earnings, to make sure you're buying a really solid business at a price that gives you a margin of safety. And all that means is you're buying it for a lot less than you think it's really worth, which kind of builds in a cushion, right? Just in case you're wrong. This whole system demands that a stock has to pass both of these tests.
And this is the key. This isn't an either-or situation. You're not a technical guy or a fundamental guy. Using both of them together acts like a super powerful cross-check. It makes sure you're not just buying a great company, but that you're buying it at the right time. And honestly, this dual filter approach can help you find amazing opportunities that other people who are kind of stuck in one camp or the other will completely miss. So how do we actually use this hybrid analysis? Well, we use it to look at two classic, time-tested investment philosophies. You really have to understand these two because they're the key to recognizing the patterns we're about to look for on the charts. First up, we've got the value method. This was made famous by the absolute legend Benjamin Graham. I want you to think of this as being a bargain hunter. You're out there looking for good, solid companies that, for whatever reason, are just temporarily unloved by the market. The whole goal is to buy them for less than they're truly worth, and that's what creates that margin of safety we were just talking about. And then, the second philosophy is the growth method, which was championed by another great, Philip Fisher. This approach, it's less about finding a bargain and way more about finding a superstar. You're looking for these outstanding companies, usually in really innovative fields that have the potential to grow way, way faster than just the average company out there. And this right here perfectly sums up the different mindset. A value investor, they want to buy a dollar for 50 cents. Simple as that. Their goal is to buy low and sell high. But a growth investor, they're totally willing to pay a fair price, maybe even a little bit of a premium for an absolutely exceptional company, because they believe its incredible growth is just going to keep pushing that price higher and higher. Their goal is to buy high and sell even higher. Okay, this is where it gets really interesting. We're moving from theory to what this stuff actually looks like in the real world. Because these two different philosophies, value and growth, they actually create recognizable repeating patterns on a stock chart. If you know what you're looking for, you can literally see these strategies playing out. Let's start with value stocks. Because these companies fall in and out of fashion with the market, their price charts often move in this really predictable four-phase cycle. And this whole cycle is driven by human emotion, flowing from total pessimism and nobody caring, all the way up to euphoria and wild speculation. And then, you guessed it, all the way back down again. And here are those four phases. It all starts with accumulation. This is where the so-called smart money, the professionals, are quietly buying up shares from investors who are just totally discouraged and selling at bargain basement prices. Then comes the markup. The public starts to catch on and the price begins a really strong uptrend. Next up is distribution. Now the stock is getting expensive, it's overvalued, and those same professionals start selling their shares to a public that's feeling euphoric. And finally, the markdown. As all that excitement fades, the price falls back down. Our job, our entire goal, is to buy late in phase 1 or early in phase 2. Now, growth stocks look completely different.
Instead of that big rolling cycle, their charts often look more like a stairway. They tend to move up in a series of really distinct steps, which makes sense because it reflects their consistent growth and profitability.
The pattern is actually pretty simple but incredibly powerful. You get a markup phase, which is just a strong upward move in the price. That's followed by a consolidation, where the price just kind of trades sideways for a while. Think of it like the stock is catching its breath. It's a healthy pause where the market is basically just waiting for the company's earnings to catch up to its now higher stock price. And then the whole pattern repeats, creating that classic stair-step look. So, we know the two philosophies, and we know what their charts are supposed to look like. Now for the really practical part. How in the world do you actually find these stocks among the thousands out there? Well, the answer is a two-pronged filtering process that lets you scan the whole market really efficiently.
I mean, that's the big question, isn't it? You can't possibly look at every single chart every single day. You'd go crazy. It's just not possible. The key is to use simple but powerful electronic filters that do all the heavy lifting for you, bringing only the most promising candidates right to your attention.
Okay, so the first method starts with the charts, with the technicals. You begin by running a scan for stocks that are hitting a new 52-week high. This immediately focuses you on stocks that are showing real strength. From that list, you confirm the uptrend with a moving average, which is just a simple line on the chart that smooths out the price to show you the general direction, and then you just visually inspect the chart. Does it look like one of our models? Only then, after it passes the eye test, do you apply the fundamental checks.
The second method completely flips the script. It starts with the fundamentals. Here, you're going to scan for stocks with a low price-to-earnings ratio, basically looking for potential bargains. You'll make sure the company is actually profitable and ideally share some of those profits through a dividend. Then you pull up the chart to see if the timing is right. Is the stock showing signs that it's bottoming out? Is it in that accumulation phase? This is a fantastic way to find those value plays before they make their big move.
Now, what's so important to see here is that the fundamental rules actually change depending on the model. For a value stock, you want a PE ratio that is significantly lower than the market average. So, if the average stock in the S&P 500 has a PE of 20, you might be looking for something under 15, maybe even 12. But for a growth stock, you're way more flexible. The PE can be higher, maybe it's 25 or 30, but that's okay as long as it's justified by really fast earnings growth and isn't just ridiculously higher than its competitors.
Okay, so after you run these filters, you're going to have this nice, manageable hot list of potential investments. They've passed the first round of tests, but you can't buy them all, right? So the final step is this really disciplined process for choosing the absolute best of the best to actually put in your portfolio. This is like the final gatekeeper. First, the obvious one. Do you actually have the cash to invest? Second, and this is important, is this new idea genuinely a better opportunity than something you already own? Maybe it's time to sell one to buy this one. Third, how does it stack up against the other great ideas on your hot list? And fourth, you always want to be thinking about diversification. You want to avoid loading up on too many stocks in the exact same industry. This whole check is not about emotion. It's a cold, hard, logical process.
Look, at the end of the day, after all the analysis, you've got to pull the trigger. But you don't have to bet the farm all at once. The idea here is to take a starting position, and then you let the market decide if you're right. If the stock starts moving up like you expected, great, you can stick with it, maybe even add to your position. But if it doesn't, if it fails, you get out. You cut it loose and you move on to the next great idea from your list.
So we have covered a lot of ground here, right? From high-level philosophy all the way down to specific rules for your stock screener. So let's pull it all together and boil this entire process down into a few crucial, memorable points that you can take with you.
So here it is. This is your new framework. Number 1, always use that dual filter system of technicals and fundamentals. Always. Number 2, identify the chart pattern. Is it a value play or a growth story? 3, use those two powerful scans. 52-week highs for momentum or low PE ratios for value to get your ideas. 4, be brutally disciplined in your final choice. And finally, number 5, let the market's performance tell you what to do. If it's working, stay with it. If it's not, you get out. And that's really the big question to leave you with. This isn't about finding some kind of magic formula that never fails. It's about having a process. A structured system like this, it takes the emotion out of it. It forces you to be disciplined, and it helps put the odds of success in your favor over the long run. And that, my friends, is the difference between speculating and truly investing.
All right, Welcome. You know, a lot of people think the glamorous part of investing is finding that perfect stock. But today, we're going to go beyond that. We're going to get into the real work, the professional's work, managing the investment after you click buy. Believe me, this is where the game is truly won or lost.
So think about it. You've done all your homework, you've found a great stock, you're excited. You click buy. And for most people, that's kind of where the thinking stops, right? But for a pro, oh no, that's where the real work, the real system actually kicks in. Because every single decision from that moment on is what's going to separate a big win from a painful loss.
Yeah, and this quote just hits the nail on the head. I mean, think about that. Two people, same stock, same day. One makes money, the other loses money. How is that possible? It's not luck, I can tell you that. It's about the system they use for managing the trade, and that's exactly what we're going to break down today, piece by piece.
All right, so here's the game plan for today. We're going to start with the foundation, rules versus guidelines. Then we'll get into your entry strategy, how to build up your position, the all-important exit strategy, and we'll wrap it up with the right mindset to make it all work.
Okay, first things first. Before we even think about buying or selling anything, we have to lay the foundation for your entire system. And it all starts with understanding this really critical distinction between absolute rules and, let's say, more flexible guidelines.
And this slide, it just lays it out perfectly. A rule, that's an absolute. It's written in stone, you never break it, period. A guideline, on the other hand, is a bit less firm. It's like your North Star, something you aim for, and maybe you get a little flexibility as you gain experience. But, and this is a big but, if you're just starting out, you need to treat every single guideline like it's a hard and fast rule. No exceptions.
Okay, so with that foundation in place, let's talk about how you actually get into a stock, your entry strategy. Now, so many people make this mistake. They try to be a hero, right? They try to catch a falling knife, find that absolute bottom. Pros don't do that. Our goal is to buy into strength. We want to find stocks that are already showing us they want to go up. And really, we're going to boil it down to two main scenarios for buying that strength. First, buying a stock when it breaks out of a sideways trading zone, and second, jumping into a stock that's already in a clear established uptrend. So let's take a look at this first strategy, buying a breakout. You see how the stock price has just been moving sideways here, stuck in this box? That's what we call consolidation. It's like a tug of war between the buyers and the sellers. But then, you see that? The breakout. When the price finally pushes above that range, it's a huge signal. It tells us the buyers have won and a brand new uptrend might be starting. That's our cue. That's where we get in. All right, now for scenario number 2, buying an existing uptrend. This one's pretty easy to spot. You can see the pattern, right? Higher peaks and higher troughs. It's like it's climbing a set of stairs. What we're looking for is confirmation that the trend is still strong. So when the price moves above its most recent peak, that's our signal. It's proof that the upward momentum is continuing, and it's a great spot to jump on board.
Okay, so you've made your initial buy. Now what? Well, here's something that separates the pros from the amateurs. Pros almost never go all in at once. This is so important. We build our position in stages. We scale in. It's a fantastic way to manage your risk and get confirmation that you're right before you put all your money on the line.
And this 3-step method is a perfect example of how to do it. You see, on that initial breakout, you start small, maybe just 2% of your capital. You're just dipping your toe in the water. Then, if the stock pulls back a little but holds up, forming a higher low, well, that's a great sign. So you add a bit more, maybe bringing it up to 4%. And finally, when it powers through to a new high, proving the trend is for real, that's when you commit to your full position. See what we're doing? We're making the stock prove us right before we give it more of our money.
And this right here brings us to what I believe is the single most important rule in this entire system. This is non-negotiable. It's an absolute. No matter how big your position is, no matter how confident you are, you never risk more than half of 1%, 0.5% of your total capital on any one investment. I'm going to say it again. Never more than 0.5%.
And look, this isn't some vague idea. It's a hard calculation that tells you exactly what to do. Let's just walk through this example so it's crystal clear. Say you have $300,000 to invest. Your max risk, that 0.5%, is $1,500. Now you figure out your risk per share. That's just the difference between your buy price and your emergency exit price, your sell stop. In this case, it's 50 cents. So you just divide your max dollar risk by your risk per share, and boom, it tells you the absolute maximum number of shares you are allowed to buy. This takes all the emotion, all the guesswork right out of it. It's pure risk management.
But you know, that 0.5% rule is completely useless if you don't have a way to enforce it. And that leads us directly to our exit strategy. I'm telling you, this is what separates real investing from just gambling. Knowing when to get out is every bit as important as knowing when to get in. Maybe even more so.
And the absolute cornerstone of your exit plan is something called a sell stop. But what is it really? Think of it this way. It's the exit price you decide on before you even own the stock. It's your I was wrong price. It's literally the last rational decision you can make before emotions like fear or that dangerous feeling of hope can take over and wreck your plan.
So where do you put it at the start? Well, if you're buying that breakout we talked about, your initial sell stop goes right below the low of that whole sideways trading range. And the logic here is just rock solid. If the price breaks out and then falls all the way back down below that entire support area, well, the breakout failed. The reason you bought it in the first place is gone. Time to get out.
Okay, but here's where it gets really smart. As the stock starts to work for you, as it moves up and makes those higher lows, you don't just leave your sell stop way down at the bottom. No way. You trail it up. You move it up right underneath each new level of support. This is just a brilliant tool. It protects your initial capital, then it starts locking in your profits, all while still giving the stock plenty of room to keep on running. It's the best of both worlds.
But trends don't always end with a big, dramatic reversal, right? Sometimes they just fizzle out. And you need rules for that too. So if your stock stops going up and just gets stuck in a new sideways pattern, you simply raise your stop to just below that new range. And this one is key. If the stock tries to rally, but it fails to make a new high, and then it breaks below its last low point, that's the trend telling you it's over. You have to listen. You sell.
So when you put all these pieces together, what do you have? You realize this isn't just a collection of random tactics. It's a system designed to completely change your mindset. It takes you from being a hopeful stock picker, crossing your fingers, to being a disciplined, unemotional business owner. And that's how you become the person who makes a profit, even when someone else buys the exact same stock on the exact same day and loses. And that's the core idea, right there. Investing is a business for me. It's not a trip to the casino. It's not about getting right all the time. It's about running an operation. It's about having a process, managing your risk, and just executing your plan over and over and over again. Your portfolio, that's your business.
So let's just quickly recap the pros playbook here. Your plan really starts after you buy. You have to know the difference between hard rules and flexible guidelines. You buy strength, not weakness. You build your positions in stages, never all at once. You never risk more than 0.5% of your capital. You always define your exit before you enter. And you let your profits run, but you protect them with a trailing stop.
Okay, now that we have the whole system laid out, I want to give you one more really powerful guideline. This is what you do when things go really well. Let's say you have a huge winner and it grows so big it becomes like 12% of your entire portfolio. That's a great problem to have, but it can also be incredibly stressful. A simple guideline is to consider selling half. You take a huge chunk of profit off the table, you cut your risk way down, and you can let that remaining half run with a whole lot less anxiety. You know, when you boil it all down, this whole system we've walked through today, that's the difference. It's what separates treating your money like a business from treating it like a lottery ticket. So I'll just leave you with this one question to think about. Are you running a business, or are you just hoping to get lucky?
You know, what if you could just look over the shoulder of a really disciplined investor and see their exact playbook? Well, that's exactly what we're going to do today. We are going to deconstruct a complete personal investment plan. I mean, everything from the core philosophy all the way down to the specific rules for every single trade. Let's dive in. Everything, and I mean everything, we're about to see really just boils down to this one sentence. This is the North Star for the entire strategy. Now, it sounds almost too simple, right? Buy when things are going up. Of course. But the real challenge, and frankly the genius of this plan, isn't the idea itself. It's building a disciplined system that forces you to follow it, especially when your emotions are screaming at you to do the exact opposite. So here's our roadmap. First, we're going to start with the foundational philosophy, the big why. Then, we'll get into the critical signals for timing the market, the when. After that, we'll explore the defensive rules that protect your capital, the how. And finally, we'll open up the tactical playbook for exactly what to buy and sell. All right, let's kick things off with part 1, the 3 core rules.
Now, you should think of these as a constitution for the entire plan. These aren't just flexible guidelines. They are the non-negotiable laws that define the why behind every single action that follows. So, the first core rule is all about radical simplicity. This plan operates in a pretty binary world. You're either invested in stocks, going for growth, or you are safely on the sidelines in cash. That's it. There's no shorting, no options, no complex derivatives. It's a long-only approach, and it's designed to capture major trends over months or even years. And here's the second rule, which is so important. Have a clear, measurable target. This plan is aiming for a 12.5% annual rate of return. A specific goal like this is absolutely crucial because it just removes all the emotion and ambiguity. It gives you a clean benchmark to answer one simple question at the end of the year. Hey, is the plan working or not? The third rule is having a clear philosophy, which breaks down into these 4 parts. First, you only play offense in bull markets. Simple. Second, you only buy individual stocks that are already in a clear uptrend. No bottom fishing. Third, you don't just jump in all at once. You build your position in stages as the stock proves you right. And fourth, and this one is maybe the most important piece of the whole puzzle, you have a clear, unemotional exit plan to get out fast if you're wrong. Okay, so that's the philosophy. But the million-dollar question is, when do you actually act on it? This section is all about the specific signals that shift the portfolio from a defensive cash position to an aggressive stock position and then back again. This is the when. Now, this plan doesn't try to be a hero and perfectly time the bottom. No way. Instead, it waits for signs of what's called distress selling. You know that moment of peak panic when investors are just dumping quality stocks at any price? Once that wave passes, that's the signal to cautiously dip a toe in the water, investing up to 20% of your capital while keeping the other 80% safe in cash. Now, for stage 2, the plan waits for a specific technical trigger, the Coppock Indicator. You don't need to be a math wizard to understand this, but it's essentially a long-term momentum tool that's designed to identify the beginning of a sustained uptrend in the broad market. So when that indicator gives the green light, the stock allocation doubles to 40%. Stage 3 is less about some complex indicator and more about pure price action. When the overall market index makes a clear upward breakout, it decisively moves above its last major peak, that's a sign of real confirmed strength. And that is a signal to get more aggressive, moving the portfolio up to a 70% stock allocation. And the final step, moving to a fully invested 100% position, well, that only happens after the new bull market has been tested. The market has to survive its first significant pullback, its first correction, and then power on to a new high. Only then, once that new uptrend is fully confirmed, does the plan go all in. It's all about patience. Getting out is just as systematic as getting in, and it's designed to lock in profits without trying to guess the exact top. As the market starts to show signs of rampant speculation, when everyone's giving you stock tips, the plan starts to take chips off the table, reducing back to 70%. As the bull market gets older and more tired, it continues to sell down to 30%. And the final critical rule: if any single stock breaks its trend, it's sold immediately, and that cash is held, not reinvested. Okay, let's talk about the seatbelts and airbags of this system. This next section is all about defense and managing risk. These are the rules designed not just to make money, but more importantly, to prevent a catastrophic loss. This is the how you protect your capital. This table shows you exactly how the plan prevents any single mistake from turning into a total disaster. No single stock gets less than 2% or more than 6% of the total capital. You're limited to 2 stocks per industry, but look, the most important rule on this screen is that last one. The maximum loss on any single stock is capped at just 0.5% of your total portfolio. That rule alone makes any single loss survivable, and that is the key to staying in the game long term. This whole strategy is built on a foundation of quality and safety. On the left, you can see what's strictly forbidden: no borrowed money, no complex derivatives, and no companies with dangerously high debt. No funny business. Instead, the focus is squarely on the right: established, profitable companies that pay dividends and are easy to trade. It's a very clear choice of stability over wild speculation. All right, we've covered the why, the when, and the how. Let's get to the final piece of the puzzle, the tactical playbook. This is where the rubber really meets the road, the specific rules for exactly what to buy and when you need to press that sell button on an individual stock. See, building a full position isn't just a single event. It's a methodical, three-step process. You start with a small, initial 2% buy on a breakout. If the stock then pulls back and forms a higher bottom, what traders call a trough, you add another 2%. The final amount is only invested once the stock proves its momentum by breaking its previous high. So each step requires confirmation from the market before more capital is put at risk. Pretty smart. And the sell rules are just as crystal clear, and they're designed to completely remove emotion from the decision. If your initial reason for buying fails, you sell. If an established uptrend breaks, you sell. If the stock starts making lower highs and lower lows, a classic sign of a trend change, you sell. These triggers are mechanical. They force discipline right when it matters most. So what happens when a stock becomes a massive winner? It's a great problem to have, right? Well, the plan has a simple rule for this. If a position performs so well that it grows to become 12% of your entire portfolio, that's double the initial maximum. The guideline is to sell half. You lock in some profit and bring the position size back down to that 6% limit. It's just a systematic way to manage risk by trimming your winners. And I love this slide because it highlights a key psychological advantage of the plan. Selling doesn't have to be forever. If you sell a stock according to the rules, but it then recovers and starts a powerful new uptrend, you're allowed to get back in. There's no ego involved here. No, oh, I was wrong. The only thing that matters is what the price is doing right now. And ultimately, that's what this is all about, isn't it? It's about taking the fear, the greed, and the general chaos of the market and filtering it all through a logical, repeatable process. A plan like this doesn't guarantee you'll always be right, but it gives you a framework to manage being wrong and to systematically capitalize on being right. And that brings us to the end of our breakdown. We've seen how every piece of this plan, from the high-level policy down to the specific tactics, fits together into one cohesive system. Now, this is just one investor's playbook, but the principles here are universal. So it leaves us with a final question for you to think about. What's the single most important rule in your own playbook? All right, welcome. Look, today we're not going to be talking about some textbook theory with those perfectly clean diagrams you always see. Nope, we're getting into the real world. We are going to follow one investor's actual journey through an entire market cycle, the roaring bull, the terrifying bear, and all the gut-wrenching decisions that happen in between. This is a playbook forged by fire. You know, this quote, it really just nails it, doesn't it? As investors, we all live right here, on the far right-hand edge of the chart, where everything to the right is just a total blank. A historian gets to look back with perfect 20/20 vision and tell you what you should have done. But we have to make our calls right now with messy, incomplete information. And that, right there, is the fundamental challenge we're going to tackle. And this right here, this really drives home the difference. On the one hand, you've got investment theory, all clean lines and predictable patterns. On the other hand, you have market reality, a chaotic, messy, ambiguous scrawl that feels designed to fake you out. In a book, you always know the outcome. In the real world, you are literally placing a bet on an unknown future. This is exactly why having a disciplined plan, well, it isn't just a nice idea. It's absolutely everything. Okay, so here's the game plan for today. We're going to start with the single biggest mental trap that trips up investors. Then we'll dive into our case study, how they actually got into the 2003 bull market, what signs told them it was time to get out before the crash, and how they navigated the absolute chaos of 2008. We'll even zoom in on one painful, costly mistake. And then we'll put it all together into a playbook that you can actually use. You know, the biggest challenge for any of us isn't picking the right stock. It's fighting what's going on up here, in our own heads. And the most dangerous enemy we have is something called hindsight bias. It's that little voice in your head that after something happens whispers, oh yeah, I knew that was going to happen. It makes us feel way smarter than we actually are, and it stops us from learning from our mistakes because we just rewrite history. All right, let's get into the nitty-gritty. How did our investor actually get into the big bull market that kicked off in 2003? Now, there was no heroic, perfectly timed call at the exact bottom, not at all. Instead, what we see is a slow, methodical, step-by-step process of getting invested over 18 months based on clear signals, not on a gut feeling. So just look at this timeline. This wasn't one big buy button moment. No way. This was a slow, deliberate 18-month campaign. Think about that. A year and a half just to get fully invested. It all starts in early 2003. The news is just awful. The Iraq War is about to start, sentiment is in the gutter. But instead of panicking, our investor sees distress as an opportunity and just dips a toe in the water. Starts building a 20% position. Then by June, a technical indicator called the Coppock Indicator, which is basically designed to sniff out long-term bottoms, flashes a buy signal. Okay, that's the trigger to get more aggressive, move to 40% invested. A few months later, the market itself confirms the move. We get a clear, undeniable uptrend. Time to build up to 70%. But notice the last step. They only go all in, 100% invested, a full year later, in June 2004, after the market proves its strength by taking out its old highs. This is pure reaction, not prediction.
Okay, so buying low, that's tough. But you know what's even harder? Deciding when to get out. It's one thing to have the courage to buy when everyone is terrified. It's a whole other level of discipline to start selling when the party is raging, the music is loud, and everyone around you is telling you you're crazy for leaving.
And I want to be really, really clear here. If your only tool was a price chart in late 2006, there was absolutely zero reason to sell. The trend was strong, it was healthy, it was pointed straight up. From a purely technical point of view, selling looked like a massive mistake.
So that's the million-dollar question, right? If the charts are screaming go, why in the world would you start tapping the brakes? Why would you reduce your exposure from 100% down to 70%? Well, the answer is that the most important signals weren't on the chart at all. They were happening out in the real world.
This is where our investor pulled out a different kind of tool. Not a chart, but a checklist, really. A rampant speculation checklist based on classic market cycle theory. And by late 2006, the warning lights were flashing all over the place. Suddenly, your neighbor's giving you stock tips at a barbecue. The stock market is on the front page of the newspaper, not just the business section. You hear stories about people quitting their jobs to become day traders. The newspaper is full of these expensive full-page ads for trading software that promise to make you rich overnight. These are the classic textbook signs that things are getting euphoric.
Ends, the list went on. You start hearing the classic, this time it's different arguments. Soft landings are here to stay. You see a ton of speculative activity, like takeovers and these super risky products called CFDs being marketed to everyday folks. Everybody, and I mean everybody, is bullish. But here's the really interesting part. One of the classic warning signs wasn't there. Traditional valuation metrics, like PE ratios, they weren't actually at crazy historic highs, but the overwhelming weight of all the other evidence, the human behavior evidence, was screaming that the market was getting dangerously frothy.
And man, this quote just says it all, doesn't it? It's a total shift in mindset. It's no longer about squeezing every last dollar of profit out of the market. The new job is to protect what you've already made. This investor decided that locking in the gains from the past few years was way more important than chasing that final manic leg up. Hey, if people laugh at you for selling too early, that's a price worth paying. And that decision to start scaling back from 100% invested down to 70% and then even more later on when everything looked rosy, well, it turned out to be the most important move they made. Because what came next was one of the worst bear markets anyone had seen in a generation. And the key to survival was simply not being in the way when the avalanche hit. From the peak in late 2007 to the bottom about a year later, the market got cut in half, and then some. It fell 53.4%. Just let that sink in for a second. More than half of all the value, gone. Every dollar you had at the top was now worth less than 47 cents. Surviving that kind of wipeout has nothing to do with picking good stocks. It has everything to do with the discipline to be sitting in cash.
So, of course, as the market is just getting hammered in late 2008, what do you start hearing everywhere? Stocks are on sale. It's a 50% off sale. This is a once-in-a-lifetime buying opportunity. So with prices absolutely crushed, was it time to be a hero and buy the dip?
And here's the beautiful part. The very same phase analysis that told him to get out early is the exact same tool that kept him out now. By December 2008, the market was squarely in what's called phase 2 of a bear market. That's when company earnings are falling off a cliff and any bad news gets punished severely. So the plan was simple. Stay 100% in cash. The time to buy is what's called phase 3, the point of total despair. That's when catastrophically bad news comes out and the market just shrugs. It doesn't go down anymore. That's the signal that all the sellers are finally exhausted. But in late 2008, we were nowhere near that point. It was still way too early.
All right, let's zoom in a bit. We've been talking big picture market cycles, but let's look at a single painful trade. because this is where the rubber really meets the road. This is where your discipline gets tested. And this is a story about what happens when you break your own rules. Okay, so let's walk through exactly what went wrong here. The rule was simple. Your safety net, your sell stop should be based on the stock's long-term weekly chart to give it room to move. But on this trade, the investor got a little too clever. He broke the rule and used a short-term daily chart instead, setting a much tighter stop. Now here's the mental trap he fell into. He thought, well, a tighter stop means less risk on each share. And because that risk per share seemed smaller, he used it as an excuse to buy a way bigger position than his rules should have allowed. And what happened? Of course, the stock had a normal, tiny pullback, it hit that super tight stop, and it forced him to sell the whole oversized position for a big loss.
You know, this quote just hits home. The market always charges high tuition fees. That one painful mistake was an expensive lesson in what a sell stop is really for. It's not just a number on a screen, it's your pre-planned escape hatch. It's there to save you from your own emotions, from hope, from greed. And it is a rule you have to follow ruthlessly, no exceptions.
And what did that tuition cost? It's right here. That one single trade, where one simple rule was broken, cost the investor almost a full percentage point, 0.91% of its entire capital. Just think about how many good decisions and profitable trades were completely wiped out by that one moment of weakness.
All right, so we've been on quite a journey, right? We've seen the bull, we've survived the bear, we even dissected a painful mistake. So, let's wrap this all up. What are the core ideas we can steal from this real-world story to build our own playbook?
So here it is, your playbook. Number 1, you have to have a plan before you need one, not when you're in the middle of a panic. 2, look beyond the charts. Use phase analysis to get a read on the human psychology that's driving the market. 3, stop trying to be perfect. You'll never buy the exact bottom or sell the exact top, so scale in and scale out. 4, remember that your job changes. In the late stages of a bull market, your number 1 job is capital preservation. 5, define your rules, especially for risk and for getting out. Write them down and follow them ruthlessly. And last but not least, you are going to make mistakes. Learn from them. They are the most expensive but most valuable lessons the market will ever teach you. Look, at the end of the day, this isn't about having a crystal ball or predicting the future. It's about having a plan. It's about being disciplined and prepared for whatever happens on that unknown right-hand edge of the chart. So the real question isn't, what's the market going to do next? The real question is, what's your plan for when it does?
You know, what if the single most important factor in your investment success isn't the market, or the economy, or even the stocks you pick? What if it's you? Today we're digging into a really powerful lesson from a veteran investor. It's a lesson that says the key to winning isn't found in a spreadsheet, but in the mirror. Let's get right into it.
Now, at first glance, that sounds, well, kind of obvious, right? But just think about it for a second. If there are many ways to make money, why do so many investors struggle to find even one? This quote isn't just a statement. It's a clue. It's telling us that the answer isn't some specific formula. It's not value versus growth or anything like that. The real secret to success is hidden somewhere else entirely.
And this is the answer. Success depends so much more on the investor than on the method they use. Just let that sink in. The most brilliant strategy in the world is absolutely useless without the right person, the right mindset executing it. Your temperament, your experience, your self-awareness, these are the real tools that build wealth, much more than any hot stock tip. In investing, success is really an inside job.
So to really get our heads around this, we're going to follow a 5-step path together. First, we'll hammer home why you are more important than your strategy. Then, we're going to peek inside an actual high-risk strategy, not to copy it, but to see how it's built. From there, we'll uncover the hidden discipline that makes it all work, which leads to a really crucial warning. And all of that is going to bring us to the final and most important step, building your own personal blueprint for success.
Okay, let's build our foundation. Why exactly is your mindset your greatest asset? Well, because the market is just a relentless test of your psychology. It doesn't care about your fancy algorithm or your degree. It's going to test your patience, it's going to test your greed, and it's definitely going to test your fear. The only thing that can stand up to that kind of pressure is a solid internal framework.
These 4 pillars, they determine everything. It doesn't matter what you're investing in, your results will always boil down to these things. First, how you think when you're under pressure. Second, the actual knowledge you bring to the table. Third, the lessons you've learned from your mistakes, your experience. And finally, maybe the most critical piece of all, You're disciplined in controlling risk and cutting your losses when you're wrong, which, by the way, you will be.
Okay, so to make this idea a little more concrete, let's move on and look inside a real active strategy. We're going to examine this author's personal method, but I need to be absolutely clear here. This is a case study, not a recommendation. Our goal is to understand how a plan is built, not to go out and copy this specific one.
So this particular strategy for beating the market is built on 3 pillars, and each one deliberately goes against what most people would call conventional wisdom. They are all active choices to embrace risk in the hopes of getting higher returns. Let's break down what each of these controversial ideas really looks like.
First up, timing the market. Now, most of the financial world is going to tell you this is a fool's errand, that you can't do it. But for this strategy, it's absolutely essential. It's not about guessing what the market will do tomorrow. It's about using specific models to decide how much of your capital should be exposed to risk at any given time. It's really the polar opposite of buy and hold. It's more like a constant strategic dance with the market.
The second pillar actively seeks out risk. Instead of sticking with the huge, stable, blue-chip companies, this strategy focuses on smaller, more volatile ones. The logic is pretty straightforward. These are the businesses that have the potential for explosive, life-changing growth. But the trade-off is just as dramatic. The downside risk is way, way higher. You're hunting for giants, but you might just find a few trapdoors along the way.
And the third pillar is concentration. Again, this just flies in the face of the classic advice, right? Diversify. This strategy says no, and instead focuses a large amount of capital on a small number of carefully chosen stocks. The upside? Your big wins can have a massive impact on your portfolio. The downside? So can your big losses. This is definitely not for the faint of heart. Okay, so we've just looked at a strategy that sounds incredibly aggressive. Timing the market, volatile stocks, concentration. I mean, it sounds like a recipe for disaster, doesn't it? But that brings us to the most important part of this whole case study, Section 3, the discipline of risk. This is the unseen foundation that makes the whole thing work. And this slide right here, this reveals the secret sauce. Just look at the two sides. On the left, you've got all the aggressive, high-risk tactics. That's the engine of the strategy. But it can only exist because of what's on the right, the brakes, an almost paranoid conservatism in every other area, an ironclad discipline, and just obsessive risk control. It's like pairing a Formula One race car driver with a world-class safety engineer. This leads us to the golden rule that holds this entire philosophy together. Think of it like a law of conservation of risk for your portfolio. If you crank up the risk in one part of your plan, you must dial it down somewhere else to compensate. Or you have to accept that higher overall risk with your eyes wide open. It's always a conscious trade-off.
And this brings us directly to the author's most critical piece of advice, and I really want you to listen closely here. Section 4 is a warning, and it's simple. Do not copy. It explains why just taking someone else's plan, no matter how successful it seems, is a recipe for failure.
Because if you ignore this next part, you are almost guaranteed to fail. The author warns that the single biggest mistake any of us can make is borrowing someone else's conviction instead of taking the time to build our own.
I mean, he couldn't be more direct. If readers try simply to follow my investment plan blindly, I expect they will fail. Why? Why is he so certain? Because a plan is so much more than just rules on a piece of paper. It's a reflection of the person who built it, their knowledge, their experience, their personal breaking points. Without that deep personal understanding, the plan is just an empty shell, and it will crack under pressure.
And this slide shows you exactly how that failure happens, step by step. In a bull market, when everything's going up, any plan looks brilliant. It's easy to be confident. But then, the market turns. The going gets tough. That plan that seems so perfect starts to show cracks, and since you didn't build it, you don't really understand why it's struggling. Uncertainty turns into fear. And in a full-blown bear market without that core personal conviction, your faith in the plan just shatters completely. You throw it out at the worst possible moment, and you're left holding the bag. So if copying is the path to failure, then what's the path to success? Well, that brings us to our final and honestly our most important section. Building your own blueprint. The real work isn't about finding a secret map. It's about having the courage to draw your own. The entire purpose of studying other great investors is not to become them. It's to steal their best ideas, their best tools, and use them to build something that is uniquely yours. A plan that fits your personality, your goals, and your temperament so perfectly that you can actually stick with it when the world feels like it's falling apart. That is the only path to lasting success. And where does that journey begin? It starts with an honest self-inventory. You have to ask yourself the hard questions. What is your true personality as an investor? Are you an optimist or a pessimist? What do you fundamentally believe about how markets work? What is your actual pain threshold for risk, not what you think it is? What has your past experience, both the good and the bad, really taught you? The answers to these questions, they become the foundation of your personal blueprint.
And so we end with this challenge. We've shown you a model, but not as a destination, more like a compass to help you start your own journey. Because the investor's final lesson is really this: the perfect plan doesn't exist out there, waiting for you to find it. It exists in here, waiting for you to build it. So what does the first draft of your blueprint look like?